Welcome everyone to an exciting journey into the world of investing. Whether you're brand new to the concept or looking to deepen your understanding, you've come to the right place. In this comprehensive guide, we'll delve into the fundamentals of investing, breaking down complex concepts into easy-to-understand terms. From understanding the importance of investing to exploring various investment strategies, we'll cover everything you need to know to start your investment journey confidently. Why invest? Ever wondered why investing is like the superhero of the financial world? Buckle up, because we're about to uncover the superpowers of investing and why it's the ultimate game changer for your financial future. Picture this. You plant a tiny acorn in your backyard today. Fast forward a few years, and bam, you've got yourself a mighty oak tree towering over your garden. That's the magic of investing, folks. By putting your money to work in the stock market, real estate, or other assets, you're planting the seeds of wealth that can grow and flourish over time. So instead of letting your money sit idly in a savings account, let it spread its wings and soar to new heights through the power of investing. Inflation, the silent killer of savings accounts everywhere. It's like trying to fill a leaky bucket with water. No matter how much you pour in, it keeps dripping out. But fear not, intrepid investors. Investing is your secret weapon against the ravages of inflation. While the purchasing power of your cash erodes over time, investments have the potential to outpace inflation and keep your wealth growing. So say goodbye to playing catch-up with rising prices and hello to staying ahead of the curve with savvy investments. Who doesn't love the idea of making money while sipping cocktails on a tropical beach? With investing, it's not just a fantasy, it's a reality. By owning assets like stocks, bonds, or rental properties, you can earn passive income without lifting a finger. Imagine waking up to find your investments have earned you a tidy sum overnight. Now that's what we call the sweet sound of cha-ching. Whether it's buying your dream home, sending your kids to college, or retiring in style, we all have financial goals we want to achieve. And guess what? Investing is the key to unlocking those dreams. By putting your money to work in the right places, you can supercharge your savings and fast-track your journey to financial freedom. So go ahead, dream big with investing by your side. Anything is possible. Let's face it, traditional savings accounts are about as exciting as watching paint dry. With interest rates hovering near zero, your money isn't doing much more than collecting dust. But investing? Now that's where the real action is. With the potential for higher returns, investing offers a thrilling alternative to the snooze fest of savings accounts. So say goodbye to penny pinching and hello to the thrill of watching your money grow. Retirement may seem like a distant speck on the horizon, but trust us, it'll be here before you know it. And when it arrives, you'll want to be prepared. Investing is like building a nest egg for your golden years. The earlier you start, the bigger and cushier that nest will be. So don't wait until the last minute to start squirreling away for retirement. Your future self will thank you for it. Investing isn't just about making money, it's about taking control of your financial destiny. By learning the ins and outs of investing, you're arming yourself with the knowledge and tools to make smart financial decisions. No more relying on luck or guesswork. With investing in your arsenal, you're the master of your own financial fate. So roll up your sleeves, sharpen your pencils, and get ready to embark on the journey of a lifetime. Now we break down the basics of making your money work for you. Get ready for some laughs, simple examples, and practical tips to help you navigate the exciting world of finance. Alright folks, imagine you're planning a road trip. You wouldn't just hop in the car and start driving aimlessly, right? Unless you're feeling adventurous, you'd pick a destination, map out your route, and maybe even plan some pit stops along the way. Investing is no different. You need to know where you're headed. So grab a pen and paper, jot down your financial goals, whether it's buying a beach house, retiring early, or splurging on that fancy coffee machine. Having clear goals will guide your investment decisions and keep you on track when the going gets tough. Risk and return, the yin and yang of investing. Think of it like this. Investing in stocks is like riding a roller coaster, thrilling highs and stomach-churning lows. On the other hand, parking your cash in a savings account is like snuggling up with a warm blanket, safe and cozy, but not much excitement. So, how much risk are you willing to stomach? It all depends on your personality and financial situation. Just remember, with great risk comes great potential for reward and the occasional heart-stopping drop. Time to talk about everyone's favorite D word: diversification. Imagine you're at a buffet. Food analogies. Would you load up your plate with just sushi? Unless you're a sushi fanatic, of course. Nah, you grab a bit of everything: sushi, pizza, salad to satisfy all your cravings. Diversifying your investments is like building a balanced buffet for your portfolio. Spread your money across different assets: stocks, bonds, real estate, to reduce your risk. That way, if one investment goes belly up, you've still got plenty of tasty options left on the table. Let's talk pizza again. I promise, this is the last food analogy for now. Picture your investment portfolio as a pizza. You've got your crust: stocks, your sauce: bonds, and your toppings: real estate, gold, whatever floats your boat. Now, how much of each ingredient do you want? That's asset allocation in a nutshell. It's all about finding the right mix of investments that matches your taste buds, your financial goals and risk tolerance. So go ahead, customize your pizza, portfolio to suit your appetite for risk and return. Time to talk about everyone's least favorite topic: fees. Nobody likes paying them, but they're a fact of life in the investing world. It's like being charged for extra guac: painful, but sometimes worth it. When you're picking investments, keep an eye out for sneaky fees that can eat into your returns. Opt for low-cost options like index funds or ETFs to save yourself some dough. After all, every dollar you save on fees is an extra dollar in your pocket or your retirement fund. Patience is a virtue, especially in investing. Trying to time the market is like trying to predict the weather. You might get lucky, but chances are you'll end up soaked. Instead of chasing rainbows, focus on staying in the market for the long haul. History shows that markets tend to go up over time, so sit back, relax, and enjoy the ride. Remember, it's not about timing the market, it's about time in the market. So buckle up and hang on tight. Life's like a box of chocolates, and so are the markets. You never know what you're gonna get. That's why it's essential to keep an eye on your investments and adjust your strategy as needed. Just like you'd tweak your recipe if your cake came out a little wonky, regularly review your portfolio and make changes if necessary. Stay nimble, stay flexible, and stay on top of your financial game. After all, it's your money. Make it work for you. Investing can be an emotional roller coaster. One minute you're on top of the world, the next you're ready to jump ship. But letting your emotions drive your investment decisions is like letting a toddler loose in a candy store. Chaos ensues. Stay cool, calm, and collected, and remember why you're investing in the first place. Oh, and don't let FOMO, fear of missing out, or FUD, fear, uncertainty, doubt cloud your judgment. Keep your eye on the prize and stay the course. You'll thank yourself in the long run. Sometimes you need to call in the experts. Cue the financial advisors. Think of them as your investing sidekicks, ready to swoop in and save the day. Whether you're a newbie investor or a seasoned pro, seeking professional advice can provide valuable insights and guidance. They'll help you navigate the murky waters of investing, avoid common pitfalls, and make smart decisions that align with your goals. So don't be shy. Reach out to a financial advisor and let them work their magic. Last but not least, never stop learning. The world of investing is like a giant playground. There's always something new to discover. Dive into books, podcasts, and YouTube videos, shameless plug, to expand your knowledge and hone your skills. The more you know, the better equipped you'll be to make informed decisions and take control of your financial future. So grab your thinking cap and get ready to geek out. Investing just got a whole lot more fun. Investing has a rich history, filled with pivotal moments and valuable lessons that have shaped the financial landscape we know today. Let's take a journey through time and explore some of the most significant events and insights that have influenced the world of investing. The infamous tulip mania, the oil bubble that rocked the Dutch Republic in the 17th century. Picture this: tulip bulbs trading for astronomical prices, fortunes made and lost overnight, and all for a fleeting flower. It's a cautionary tale of speculation run amok and the perils of irrational exuberance. Lesson learned? Don't get caught up in the hype. Invest wisely and keep your feet firmly planted on the ground. Fast forward to the early 18th century, and we've got another doozy of a bubble, the South Sea bubble. This time, it's the British Empire's turn to experience a frenzy of speculation and irrational investing. The South Sea Company promised untold riches from trade with South America, sending its stock price soaring to dizzying heights. But when the bubble burst, investors were left holding the bag, and the fallout was felt far and wide. The lesson? If it sounds too good to be true, it probably is. Do your due diligence and don't let greed cloud your judgment. The Great Depression, the granddaddy of all financial crises. It was a perfect storm of economic turmoil, with stock market crashes, bank failures, and mass unemployment sending shockwaves around the world. But amidst the chaos, there were valuable lessons to be learned. From the importance of diversification to the need for strong regulatory oversight, the Great Depression reshaped the way we think about investing and laid the groundwork for modern financial markets. Fast forward to the dawn of the internet age, and we've got ourselves another bubble, the dot-com bubble. It was a time of wild speculation and irrational exuberance, with investors flocking to anything with a .com in its name. Pets.com, Webvan, e-toys, you name it, investors were throwing money at it. But when the bubble burst in the early 2000s, it was a rude awakening for many. Lesson learned? Don't let FOMO, fear of missing out, cloud your judgment. Invest in companies with solid fundamentals and a clear path to profitability. The GFC, a modern-day cautionary tale of greed, recklessness, and financial folly. It was a time of subprime mortgages, complex financial derivatives, and too-big-to-fail banks teetering on the brink of collapse. When the house of cards finally came crashing down, it sent shockwaves through the global economy and left millions of people reeling in its wake. But amidst the chaos, there were valuable lessons to be learned about the dangers of excessive leverage, lax regulation, and herd mentality. But it's not all doom and gloom in the world of investing, far from it. In recent years, we've seen the rise of index funds and exchange-traded funds, ETFs, revolutionizing the way everyday investors approach the market. With their low costs, broad diversification, and passive approach to investing, index funds and ETFs have leveled the playing field and empowered investors of all shapes and sizes to build wealth for the long term. And finally, we come to the GameStop saga, a modern-day David and Goliath story that captivated the world. It was a battle between hedge funds and retail investors, with social media, memes, and short squeezes thrown into the mix. While the dust has yet to settle on this particular chapter, it's a reminder that the investing landscape is constantly evolving and that everyday investors have more power than they realize. Economic and political factors are like the weather of the investment world, constantly changing and influencing market conditions. In this section, we'll explore how economic and political factors can affect investment decisions and what investors can do to navigate these challenges. Economic indicators provide valuable insights into the health and direction of the economy. From gross domestic product (GDP) and unemployment rates to inflation and consumer confidence, economic indicators help investors gauge the strength of the economy and identify potential investment opportunities and risks. Interest rates have a profound impact on asset prices and investment returns. When interest rates are low, borrowing costs are cheap, fueling economic growth. Conversely, rising interest rates can slow economic activity and put downward pressure on asset prices. Investors need to pay close attention to central bank policy decisions and interest rate movements to anticipate their impact on different asset classes. Inflation silently erodes the purchasing power of money over time. While moderate inflation is a sign of a healthy economy, runaway inflation can erode investment returns and diminish the value of savings. Investors need to consider the impact of inflation on their investment portfolios and seek out assets that can preserve their purchasing power over the long term. Geopolitical risks are looming threats that can disrupt global markets and cause investor anxiety. From trade tensions and geopolitical conflicts to natural disasters and pandemics, geopolitical risks can have far-reaching implications for investment portfolios and market sentiment. Investors can mitigate their impact by diversifying their portfolios and maintaining a long-term perspective. Changes in regulations and government policies can have significant implications for different industries and sectors, impacting investment returns and risk profiles. Investors need to stay informed about regulatory developments and their potential impact on their investment portfolios, adjusting their strategies as needed to navigate changing market conditions and regulatory requirements. Globalization and trade dynamics can have profound effects on investment portfolios and market trends. From free trade agreements and supply chain disruptions to currency fluctuations and trade wars, globalization and trade dynamics require investors to consider the implications on different asset classes and sectors, positioning their portfolios to capitalize on opportunities and mitigate risks in an interconnected world. Government intervention, such as monetary policy measures and fiscal stimulus packages, can impact investment markets and asset prices. Investors need to monitor economic policy developments and their potential implications for inflation, interest rates, and market sentiment, adjusting their investment strategies accordingly to manage risks and capitalize on opportunities. Government intervention, such as monetary policy measures and fiscal stimulus packages, can impact investment markets and asset prices. Investors need to monitor economic policy developments and their potential implications for inflation, interest rates, and market sentiment, adjusting their investment strategies accordingly to manage risks and capitalize on opportunities. Technology has completely revolutionized the way we approach investing. Gone are the days of relying solely on financial advisors and traditional brokerage firms. Nowadays, technology empowers individual investors like never before, providing access to a wealth of information, tools, and resources at our fingertips. Let's delve into how technology is reshaping the investment landscape. Think of online trading platforms as your gateway to the financial markets. These platforms allow you to buy and sell stocks, bonds, ETFs, and other securities from the comfort of your home. With intuitive interfaces and real-time data, platforms like TD Ameritrade, Charles Schwab, and Interactive Brokers make it easy for investors of all levels to execute trades and manage their portfolios with confidence. The rise of mobile technology has made investing more accessible than ever. Mobile apps from brokerage firms and fintech companies allow you to monitor your investments, research stocks, and execute trades on the go. Whether you're commuting to work or lounging on the couch, apps like Robinhood, Webull, and E-Trade put the power of investing in the palm of your hand. Robo-advisors have democratized investment management by offering automated portfolio management services at a fraction of the cost of traditional financial advisors. These platforms use algorithms to create and rebalance diversified portfolios based on your risk tolerance and investment goals. Examples include Betterment, Wealthfront, and M1 Finance, which cater to investors seeking low-cost, hands-off investing solutions. Artificial intelligence and big data analytics have transformed how investors analyze markets and make investment decisions. Advanced algorithms can process vast amounts of data to identify trends, predict market movements, and uncover investment opportunities. Tools like Bloomberg Terminal, Thinkorswim, and AlphaZense provide institutional-grade research and analytics to individual investors, leveling the playing field in the financial markets. Technology has democratized financial education, empowering investors to expand their knowledge and improve their skills. Online courses, webinars, podcasts, and blogs offer valuable insights into investing strategies, market trends, and personal finance topics. Platforms like Investopedia, Seeking Alpha, and The Motley Fool provide educational content tailored to investors of all levels, helping them make informed decisions and achieve their financial goals. Technology has democratized investing, giving individual investors unprecedented access to information, tools, and resources. Whether you're a seasoned trader or a novice investor, leveraging technology can help you navigate the complexities of the financial markets and build wealth over the long term. Investing isn't just about chasing profits, it's also about making choices that align with your values and principles. In this section, we'll explore the ethical considerations that come into play when making investment decisions, and how you can invest in a way that reflects your beliefs. ESG investing is all about putting your money where your values are. This approach considers environmental, social, and governance factors, alongside financial returns when evaluating investment opportunities. Whether you're passionate about combating climate change, promoting social justice, or advocating for corporate transparency and accountability, ESG investing allows you to support companies that share your values and contribute to positive change in the world. Socially responsible investing takes ESG principles a step further by actively excluding or including companies based on specific social or ethical criteria. SRI investors may avoid industries like tobacco, firearms, or gambling, while favoring companies with strong records on human rights, diversity, and community engagement. By aligning their investments with their values, SRI investors can make a positive impact on society while potentially achieving competitive financial returns. Impact investing goes beyond avoiding harm, it seeks to generate positive, measurable social and environmental impact alongside financial returns. Impact investors actively seek out opportunities to support businesses, organizations, and projects that address pressing social and environmental challenges, such as poverty alleviation, clean energy, and affordable housing. By directing capital towards solutions-oriented initiatives, impact investors can drive meaningful change while still pursuing their financial goals. As shareholders, investors have a voice in how companies are run, and can use their influence to advocate for ethical business practices and corporate governance reforms. Shareholder activism involves engaging with company management and other shareholders to address issues like executive compensation, board diversity, and environmental policies. By holding companies accountable for their actions and pushing for positive change, investors can help create a more ethical and sustainable business environment. Whether you're a passive investor or an active participant in the market, staying informed and engaged is crucial to making ethical investment decisions. Researching companies' ESG profiles, voting your proxies, And supporting shareholder resolutions are just a few ways investors can promote ethical business practices and drive positive change in the companies they invest in by considering the ethical implications of their investment decisions and actively supporting companies and initiatives that align with their values. Investors can not only generate financial returns but also make a meaningful impact on the world around them. When it comes to investing, one size doesn't fit all. Different investors have different risk tolerances, goals, and time horizons, which influence their approach to risk. In this section, we'll explore 3 common risk profiles: conservative, moderate, and aggressive, and how they shape investment strategies. Picture yourself as a cautious investor, someone who values capital preservation and prioritizes stability over potential gains. A conservative approach to investing typically involves allocating a significant portion of your portfolio to low-risk assets, such as cash, bonds, and blue-chip stocks. While conservative investors may sacrifice some potential returns in exchange for lower volatility and reduced exposure to market fluctuations, they prioritize protecting their principal and generating steady income streams. Now, let's dial up the risk factor a bit. Moderate investors are like the Goldilocks of the investment world: not too hot, not too cold, but just right. They strike a balance between risk and reward by diversifying their portfolios across a mix of asset classes, including stocks, bonds, and alternative investments. While moderate investors are willing to accept some level of volatility in pursuit of higher returns, they also prioritize capital preservation and aim for a smoother, more consistent growth trajectory over the long term. Ready to crank up the adrenaline? Aggressive investors are like thrill seekers in the investment world. They're willing to take on higher levels of risk in pursuit of potentially higher rewards. An aggressive approach to investing typically involves allocating a significant portion of your portfolio to high-growth assets such as stocks, real estate, and emerging markets. While aggressive investors may experience greater volatility and short-term losses, they're willing to ride out market fluctuations in pursuit of long-term capital appreciation. Your risk profile isn't set in stone; it can evolve over time, based on factors like your financial situation, investment goals, and life stage. Younger investors with a longer time horizon may feel comfortable taking on more risk, as they have more time to recover from market downturns and benefit from the power of compounding. On the other hand, retirees or those nearing retirement may adopt a more conservative approach to protect their nest egg and generate steady income in their golden years. Regardless of your risk profile, the key is to strike a balance between risk and reward that aligns with your financial goals and comfort level. Diversification, asset allocation, and periodic portfolio rebalancing are essential tools for managing risk and optimizing returns over the long term. By understanding your risk profile and crafting a well-diversified investment strategy, you can navigate the ups and downs of the market with confidence and achieve your financial objectives. In summary, your approach to risk plays a crucial role in shaping your investment strategy and ultimately determining your investment outcomes. Whether you're a conservative investor seeking stability, a moderate investor aiming for balanced growth, or an aggressive investor chasing higher returns, understanding your risk profile is the first step toward building a resilient and successful investment portfolio. The US dollar holds a unique position in the world of investing, serving as the primary reserve currency and influencing global markets in significant ways. In this section, we'll explore the various ways in which the dollar affects international investments and what investors need to know to navigate its impact. The US dollar is the world's primary reserve currency, meaning it is held by central banks and governments as part of their foreign exchange reserves. This status gives the dollar unparalleled liquidity and demand. making it the preferred currency for international trade, investment, and transactions. As a result, changes in the value of the dollar can have ripple effects across global financial markets, affecting asset prices, exchange rates, and investment returns. The dollar's strength often has an inverse relationship with commodity prices. Since many commodities, such as oil and gold, are priced in dollars on global markets, a stronger dollar can make commodities more expensive for buyers in other currencies, leading to lower demand and downward pressure on prices. Conversely, a weaker dollar can make commodities more affordable for foreign buyers, stimulating demand and driving prices higher. Investors with exposure to commodity markets need to monitor currency movements and their impact on commodity prices to make informed investment decisions. Changes in U.S. interest rates can influence the value of the dollar and capital flows into and out of the United States. Higher interest rates tend to attract foreign investment, as investors seek higher yields on dollar-denominated assets. This increased demand for dollars can strengthen the currency, potentially impacting the competitiveness of U.S. exports and the profitability of multinational companies. Conversely, lower interest rates may lead to capital outflows and a weaker dollar, which can benefit exporters and boost corporate earnings. Geopolitical events and uncertainties can also impact the value of the dollar and investor sentiment towards U.S. assets. Political instability, trade tensions, and global economic uncertainties can drive demand for safe haven assets, such as U.S. Treasury bonds and the dollar, as investors seek refuge from market volatility. Understanding the interplay between geopolitical developments and currency markets is crucial. For investors navigating global markets and managing currency risk, the U.S. dollar plays a central role in global investments, influencing currency markets, asset prices, and investment returns. By understanding the factors that drive dollar movements and their impact on international investments, investors can make informed decisions to optimize their portfolios and navigate changing market conditions with confidence. Imagine waking up on a Monday morning and realizing you never have to go to work again. That's the magic of financial independence. It's like having a secret stash of cash that pays for all your expenses without you lifting a finger. Financial independence means having enough money from your investments to live life on your terms, whether it's traveling the world, pursuing your passions, or simply enjoying a lazy day at home in your pajamas. Think of your investment portfolio as a delicious buffet spread. You want a little bit of everything to satisfy your hunger for wealth. Diversify your investments across stocks, bonds, real estate, and maybe even a sprinkle of cryptocurrency for some extra spice. Just like a well-balanced meal, a diversified portfolio can help you weather the storms and grow your wealth over time. Let's talk about the eighth wonder of the world: compounding. It's like planting a money tree in your backyard and watching it grow taller and taller with each passing year. Whether you're earning dividends from stocks or interest from bonds, reinvesting those earnings can turbocharge your wealth-building journey. It's like turning a penny into a dollar, and then that dollar into 10. Compounding is the gift that keeps on giving. Picture yourself on a road trip to financial freedom. You need a map to guide you, right? Setting clear financial goals is like plotting your course on that map. Whether it's retiring early, buying a beach house, or finally splurging on that dream vacation, having specific goals gives you something to aim for. Break down your goals into bite-sized chunks, like saving a certain amount each month or hitting a milestone net worth, and watch as you inch closer and closer to your destination. Let's talk about budgeting. It's like going on a diet, but for your wallet. Avoiding lifestyle inflation means resisting the temptation to upgrade your lifestyle every time you get a raise. Sure, you could buy that fancy new car or upgrade to a bigger house, but do you really need it? By keeping your expenses in check and living below your means, You can free up more money to invest and fast-track your journey to financial independence. Don't forget to invest in the most important asset of all, yourself. Whether it's taking online courses, attending workshops, or honing your skills, investing in yourself can pay dividends in the form of increased earning potential and career advancement. Think of it as sharpening your axe before you start chopping down trees. Investing in yourself lays the foundation for future success. Sometimes you need a little help from the pros. Just like you wouldn't perform surgery on yourself, seeking advice from a financial advisor can provide valuable insights and guidance. They can help you navigate the complexities of investing, build a personalized strategy tailored to your goals, and keep you on track during turbulent times. Think of them as your financial GPS, guiding you to your destination with precision and expertise. Rome wasn't built in a day, and neither is your wealth. Achieving financial independence takes time, discipline, and a whole lot of patience. Stick to your investment plan, resist the urge to chase hot tips or time the market, and stay focused on your long-term goals. Remember, slow and steady wins the race. Stay the course, and you'll reap the rewards in due time. Last but not least, don't forget to enjoy the journey to financial independence. Life's too short to be stressed about money all the time. Take time to celebrate your victories, treat yourself to the occasional splurge, and savor the freedom and opportunities that financial independence brings. After all, isn't that what it's all about? Achieving financial independence is like embarking on the ultimate adventure. It's exciting, challenging, and incredibly rewarding. By building a diversified portfolio, harnessing the power of compounding, setting clear goals, and managing your expenses wisely, you can turn your dreams of financial freedom into reality. Imagine waking up to the sweet sound of your bank account growing while you sleep. That's the magic of passive income. Unlike active income, which requires you to trade your time for money like a traditional 9-to-5 job, passive income is money earned with minimal effort on your part. It's like having a money-making machine that works tirelessly in the background, generating cash flow day in and day out. Passive income can take many forms, from rental income from real estate properties to dividends from stocks and interest from bonds. It's like having multiple streams of income flowing into your bank account, providing stability and security even when you're not actively working. The key is to diversify your sources of passive income to minimize risk and maximize potential returns. Passive income offers several advantages that make it a valuable component of any investment portfolio. First and foremost, it provides financial stability and peace of mind. Knowing that you have a steady stream of income to cover your expenses, regardless of market conditions or economic downturns. It also offers flexibility and freedom, allowing you to spend more time pursuing your passions, traveling, or enjoying quality time with loved ones. Additionally, passive income can serve as a hedge against inflation, as many passive income streams are linked to the underlying value of assets, which tend to appreciate over time. Incorporating passive income-generating assets into your investment portfolio is essential for long-term wealth building. Real estate investment trusts, REITs, dividend-paying stocks, peer-to-peer lending platforms, and rental properties are just a few examples of assets that can generate passive income. By diversifying across different asset classes and income streams, you can create a resilient portfolio that can weather market volatility and provide steady returns over the long term. While passive income requires less effort than active income, it still requires careful planning and management to maximize its potential. This may involve researching and selecting high-quality income-generating assets, monitoring your investments regularly, and making adjustments as needed to optimize your portfolio's performance. Additionally, reinvesting your passive income back into your portfolio can accelerate its growth, and compound your returns over time, further increasing your passive income stream. As technology continues to evolve, new opportunities for generating passive income are emerging. From online businesses and digital products to subscription services and affiliate marketing, the possibilities are endless. The key is to stay informed, adapt to changing market trends, and seize opportunities as they arise. With the right mindset and strategy, passive income can become a powerful tool for achieving financial independence and creating the lifestyle of your dreams. Passive income plays a crucial role in building wealth and achieving financial independence. By incorporating passive income-generating assets into your investment portfolio and maximizing their potential, you can create a reliable stream of income that supports your financial goals and provides the freedom to live life on your terms. Setting clear financial goals is the first step on your investment journey. Just like planning a road trip, having a destination in mind helps guide your decisions and keeps you on track. Financial goals give you a sense of purpose and direction, motivating you to save, invest, and make smart financial choices. Whether it's buying a home, saving for retirement, or starting a business, defining your financial goals lays the groundwork for success. Financial goals can be short-term, medium-term, or long-term, depending on your timeline and objectives. Short-term goals are typically achievable within 1 to 3 years and may include saving for a vacation, buying a new car, or building an emergency fund. Medium-term goals have a time frame of 3 to 7 years and may involve saving for a down payment on a home or funding a child's education. Long-term goals, such as retirement planning, wealth accumulation, or legacy planning, extend beyond 7 years and require a more strategic approach. When setting financial goals, it's essential to make them smart, specific, measurable, achievable, relevant, and time-bound. Specific goals clearly define what you want to achieve and why it's important to you. Measurable goals have quantifiable metrics that allow you to track your progress and celebrate milestones along the way. Achievable goals are realistic and within your reach, considering factors like income, expenses, and resources. Relevant goals align with your values, priorities, and long-term objectives. Time-bound goals have a clear deadline or time frame for completion, creating a sense of urgency and accountability. With so many financial goals competing for your attention, it's essential to prioritize them based on their importance and urgency. Start by identifying your most pressing needs and aspirations, such as paying off high-interest debt, building an emergency fund, or saving for retirement. Once you've addressed your immediate priorities, you can allocate resources towards other goals, such as buying a home, starting a business, or funding your children's education. Remember to reassess your goals regularly and adjust your plan as needed to reflect changes in your circumstances or priorities. Large, daunting goals can feel overwhelming, making it difficult to get started. Break down your financial goals into smaller, actionable steps to make them more manageable and achievable. For example, if your long-term goal is to save $1 million for retirement, break it down into smaller milestones, such as saving $100,000 in 5 years or increasing your retirement contributions by 1% each year. Celebrate each milestone as you progress towards your larger goal, and use setbacks as learning opportunities to refine your approach. Visualization is a powerful tool for achieving your financial goals. Create a vision board or journal where you can visualize your goals and dreams, using images, quotes, and affirmations to bring them to life. Visualizing your goals regularly can help keep you motivated and focused on what you want to achieve. It's like having a roadmap that reminds you of your destination and inspires you to keep moving forward, even when the journey gets tough. Setting clear, smart financial goals is the foundation of successful investing. By defining your objectives, prioritizing your aspirations, and breaking down your goals into actionable steps, you can create a roadmap for financial success and turn your dreams into reality. Before diving into the world of investing, it's crucial to take stock of your current financial situation. Think of it as giving yourself a financial checkup to gauge your overall health and identify areas for improvement. Assessing your financial situation involves evaluating your income, expenses, assets, liabilities, and overall financial stability. One of the first steps in assessing your financial health is calculating your net worth. This is the difference between your assets, what you own, and your liabilities, what you owe. Your assets may include cash, investments, real estate, vehicles, and valuable possessions, while your liabilities may include mortgages, car loans, student loans, credit card debt, and other obligations. Subtracting your liabilities from your assets gives you a snapshot of your net worth, which is a measure of your overall financial strength and stability. Take a close look at your income and expenses to understand your cash flow, the money coming in versus the money going out. Your income includes earnings from employment, investments, rental properties, side hustles, and any other sources of revenue. Your expenses encompass all your spending, including housing, transportation, utilities, groceries, entertainment, debt payments, and savings contributions. Analyzing your income and expenses helps you identify areas where you can reduce costs, increase savings, and optimize your budget for financial success. Your savings rate is the percentage of your income that you save or invest each month. It's a critical metric for evaluating your financial health and progress towards your goals. Aim to save at least 20% of your income, but ideally 30% or more, to build a solid financial foundation and achieve your long-term objectives. Increasing your savings rate is one of the most effective ways to accelerate your wealth-building journey and achieve financial independence faster. Debt can be a double-edged sword. It can help you finance major purchases and investments, but it can also become a burden if not managed properly. Review your debt levels, including the types of debt you have, the interest rates, and the repayment terms. Focus on paying off high-interest debt first, such as credit card balances or payday loans, as they can quickly spiral out of control and hinder your financial progress. Consider consolidating or refinancing your debt to lower your interest rates and simplify your repayment plan. An emergency fund is like a financial safety net that protects you from unexpected expenses or income disruptions. Aim to have at least 3 to 6 months' worth of living expenses saved in an easily accessible account, such as a high-yield savings account or a money market fund. Your emergency fund provides peace of mind and financial security, allowing you to weather any storms that may arise without derailing your long-term goals. Assessing your financial situation is a crucial step in preparing for investing. By understanding your net worth, analyzing your income and expenses, evaluating your savings rate, reviewing your debt levels, and ensuring you have an adequate emergency fund, you can lay the foundation for a successful investment journey. Debt can be a significant obstacle to building wealth and achieving financial freedom. Before diving into investing, it's essential to assess your debt situation and develop a strategy for managing it effectively. Debt comes in many forms, including credit card debt, student loans, mortgages, car loans, and personal loans. While some debt may be considered good debt, such as low interest mortgages or student loans that finance education, high-interest consumer debt can quickly become a burden and hinder your financial progress. When it comes to managing debt, it's crucial to prioritize high-interest debt, such as credit card balances or payday loans. These types of debt typically carry the highest interest rates and can quickly spiral out of control if left unchecked. Focus on paying off high-interest debt as quickly as possible to minimize interest costs and free up more money for saving and investing. Consider using the debt snowball or debt avalanche method to accelerate your debt repayment and gain momentum towards becoming debt-free. Consolidating or refinancing your debt can be an effective strategy for reducing your interest rates and simplifying your repayment plan. Consolidation involves combining multiple debts into a single loan with a lower interest rate, while refinancing entails replacing an existing loan with a new loan at a lower interest rate. By consolidating or refinancing your debt, you can save money on interest, lower your monthly payments, and pay off your debt more quickly. Developing a debt repayment plan is essential for staying on track and making progress towards becoming debt-free. Start by listing all your debts, including the outstanding balance, interest rate, and minimum monthly payment. Then, prioritize your debts based on their interest rates, focusing on paying off high-interest debt first while making minimum payments on the rest. Consider allocating any extra income, windfalls, or bonuses towards debt repayment to accelerate your progress and achieve your goals sooner. While paying off existing debt is essential, it's equally important to avoid taking on new debt while you're working towards financial freedom. Resist the temptation to use credit cards for unnecessary purchases, take out loans for luxury items, or finance a lifestyle beyond your means. Instead, focus on living within your means, budgeting wisely, and building healthy financial habits that support your long-term goals. Remember, every dollar you save on interest and debt payments is a dollar you can invest in your future. Tracking your debt repayment progress is key to staying motivated and accountable. Regularly review your debt balances, update your repayment plan as needed, and celebrate milestones along the way. Consider using tools and resources like budgeting apps, debt payoff calculators, or financial spreadsheets to keep track of your progress and visualize your journey towards debt freedom. By staying focused and disciplined, you can conquer your debt and pave the way for a brighter financial future. Managing debt before investing is essential for laying a solid foundation for your financial journey. By prioritizing high-interest debt, consolidating or refinancing loans, creating a debt repayment plan, avoiding new debt, and monitoring your progress, you can take control of your finances, reduce financial stress, and set yourself up for long-term success. An emergency fund is like a financial safety net that provides a cushion against unexpected expenses or income disruptions. It's a pool of money set aside specifically for emergencies, such as medical bills, car repairs, job loss, or unexpected home repairs. Having an emergency fund in place can prevent you from going into debt or tapping into your long-term investments when life throws you a curveball. The size of your emergency fund depends on several factors, including your monthly expenses, income stability, and risk tolerance. A common rule of thumb is to aim for 3 to 6 months' worth of living expenses saved in your emergency fund. However, your specific circumstances may warrant a larger or smaller emergency fund. For example, if you have a stable job and minimal expenses, you may feel comfortable with a smaller emergency fund. Conversely, if you have irregular income or high expenses, you may want to aim for a larger emergency fund to provide greater financial security. Building an emergency fund doesn't happen overnight. It requires consistent saving and disciplined financial habits. Set specific savings goals for your emergency fund, breaking them down into manageable milestones. Start by saving 1 month's worth of expenses, then gradually work your way up to 3, 6, or even 12 months' worth of expenses. Automate your savings by setting up automatic transfers from your checking account to your emergency fund each month, making it easier to stay on track and avoid temptation. When building an emergency fund, it's essential to choose the right type of account to maximize safety, liquidity, and growth. Look for a high-yield savings account or a money market account that offers competitive interest rates and easy access to your funds. Avoid tying up your emergency fund in investments or retirement accounts that may be subject to market fluctuations or early withdrawal penalties. Keep your emergency fund separate from your everyday spending accounts to reduce the temptation to dip into it for non-emergencies. Once you've built up your emergency fund, it's crucial to maintain it over time and replenish any funds used for emergencies. Make it a habit to review your emergency fund regularly and adjust your savings goals as needed, based on changes in your expenses, income, or financial goals. Consider reallocating windfalls, bonuses, or tax refunds towards your emergency fund to boost your savings. And ensure you're prepared for whatever life throws your way. While it's important to have an emergency fund for unexpected expenses, it's equally important to use it wisely and avoid tapping into it for non-emergencies. Reserve your emergency fund for genuine emergencies that threaten your financial stability or well-being, such as medical emergencies, job loss, or major home repairs. Avoid using your emergency fund for discretionary expenses or impulse purchases, as this can deplete your savings and leave you vulnerable in a true emergency. Building an emergency fund is a critical aspect of financial planning and preparedness. By understanding the importance of an emergency fund, determining the right size for your needs, setting savings goals, choosing the right account, maintaining your fund over time, and using it wisely, you can create a solid financial safety net and protect yourself from life's unexpected challenges. Behavioral finance is a branch of economics that explores how psychological factors influence financial decision-making. Unlike traditional finance theories, which assume that individuals always act rationally and in their best interests, behavioral finance acknowledges that emotions, biases, and cognitive errors can lead to irrational behavior and suboptimal financial outcomes. By understanding the principles of behavioral finance, you can identify common psychological traps and biases that may impact your financial decisions and learn how to overcome them. Cognitive biases are systematic patterns of thinking that can cloud judgment and distort perception. They can affect how we interpret information, assess risk, and make decisions, often leading to irrational behavior and poor financial choices. Common cognitive biases include confirmation bias, anchoring bias, overconfidence bias, loss aversion, and herd mentality. By recognizing these biases and their influence on your decision-making process, you can take steps to mitigate their effects and make more informed financial decisions. Emotions play a significant role in investing, influencing decisions such as buying, selling, or holding investments. Emotional investing driven by fear, greed, or herd mentality can lead to impulsive actions and suboptimal outcomes. To overcome emotional investing, it's essential to cultivate emotional intelligence and develop strategies for managing your emotions effectively. Practice mindfulness techniques, such as deep breathing or visualization, to stay calm and focused during market volatility. Stick to a well-thought-out investment plan and avoid making impulsive decisions based on short-term market fluctuations or emotional reactions. Unrealistic expectations can set you up for disappointment and frustration in your financial journey. Avoid comparing yourself to others or chasing unrealistic returns in the market. Instead, focus on setting realistic, achievable goals based on your individual circumstances, risk tolerance, and investment horizon. Understand that investing is a long-term endeavor, and success often comes from consistency, patience, and discipline rather than chasing short-term gains or trying to time the market. Financial resilience is the ability to bounce back from setbacks, adapt to change, and navigate challenges effectively. Cultivate resilience by building a diversified investment portfolio, establishing an emergency fund, and maintaining a healthy balance between risk and reward. Focus on building multiple income streams, reducing debt, and living below your means to increase your financial flexibility and security. Remember that setbacks are a natural part of the financial journey and can provide valuable learning opportunities for growth and improvement. If you find yourself struggling with managing your finances or making investment decisions, don't hesitate to seek professional guidance from a financial advisor or planner. A qualified advisor can provide personalized advice tailored to your unique goals, circumstances, and risk tolerance. They can help you develop a comprehensive financial plan, optimize your investment strategy, and navigate complex financial decisions with confidence and peace of mind. Understanding the psychology of personal finance is essential for making informed, rational financial decisions and achieving long-term success. By recognizing cognitive biases, overcoming emotional investing, setting realistic expectations, developing financial resilience, and seeking professional guidance when needed, you can take control of your financial future and build wealth with confidence. Financial education lays the groundwork for successful investing by providing you with the knowledge and skills needed to make informed decisions about your money. It equips you with the tools to understand basic financial concepts such as budgeting, saving, investing, and managing debt, as well as more advanced topics like asset allocation, portfolio diversification, and risk management. By investing in your financial education, you can gain the confidence and competence to navigate the complexities of the financial markets and achieve your long-term goals. A solid understanding of investment options is essential for building a well-rounded investment portfolio that aligns with your goals, risk tolerance, and time horizon. Financial education helps you explore different investment vehicles, such as stocks, bonds, mutual funds, exchange-traded funds, ETFs, real estate, and alternative investments. It teaches you how each asset class works, its potential risks and rewards, and how to assess its suitability for your portfolio. By understanding your investment options, you can make informed decisions about where to allocate your capital and optimize your investment strategy for long-term growth and stability. Investing involves taking on risk in pursuit of potential returns. Financial education helps you understand the relationship between risk and return and how to assess and manage investment risk effectively. It teaches you how to evaluate the risk profile of different investments, measure volatility, and diversify your portfolio to reduce risk exposure. By understanding the trade-offs between risk and return, you can make informed decisions about balancing risk and reward in your investment portfolio and achieving your financial objectives. Financial education empowers you to develop personalized investment strategies based on your goals, risk tolerance, and time horizon. It teaches you how to create a well-thought-out investment plan, set realistic expectations, and stick to your strategy through market ups and downs. Whether you're a conservative investor seeking steady income, a moderate investor looking for a balance of growth and stability, or an aggressive investor pursuing higher returns, financial education provides you with the tools and knowledge to design a strategy that aligns with your individual needs and preferences. Investing without adequate financial education can lead to costly mistakes and missed opportunities. Financial education helps you avoid common pitfalls, such as chasing hot investment trends, succumbing to fear or greed, and making impulsive decisions based on emotion or speculation. It teaches you to approach investing with discipline, patience, and a long-term perspective, focusing on fundamental principles rather than short-term market fluctuations. By learning from the mistakes of others and applying sound investment principles, you can enhance your investment success and minimize the likelihood of costly errors. Financial markets are constantly evolving, and staying informed is key to staying ahead. Financial education is an ongoing process that requires continuous learning and adaptation to new developments, trends, and opportunities in the market. Make a commitment to lifelong learning by staying informed through books, articles, courses, seminars, webinars, and other educational resources. Surround yourself with knowledgeable mentors, advisors, and peers who can provide valuable insights and guidance on your financial journey. Financial education is the foundation of successful investing. By building a strong foundation, understanding investment options, evaluating risk and return, developing investment strategies, avoiding common pitfalls, and committing to lifelong learning, you can empower yourself to make informed decisions, navigate the complexities of the financial markets, and achieve your long-term financial goals. Financial planning is the process of setting goals, evaluating resources, and developing strategies to achieve financial objectives. A financial planner is a professional who helps individuals and families create comprehensive financial plans tailored to their specific needs, goals, and circumstances. By working with a financial planner, you can gain valuable insights, guidance, and support to make informed decisions about your investments and achieve your long-term financial goals. One of the first steps in financial planning is assessing your current financial situation. A financial planner will help you evaluate your assets, liabilities, income, expenses, and cash flow to gain a clear understanding of your financial position. They will also consider other factors such as your risk tolerance, investment timeline, tax situation, and financial goals to develop a customized investment strategy that aligns with your objectives. Setting clear, measurable financial goals is essential for guiding your investment decisions and ensuring that your financial plan aligns with your priorities. A financial planner will work with you to identify short-term and long-term goals, such as saving for retirement, buying a home, funding education, or building wealth. They will help you prioritize your goals, break them down into actionable steps, and develop a timeline for achieving them. Once your financial goals are established, a financial planner will help you develop an investment strategy designed to achieve those goals while managing risk effectively. They will consider factors such as your risk tolerance, time horizon, investment preferences, and tax considerations to recommend a diversified portfolio of investments tailored to your needs. Your investment strategy may include a mix of stocks, bonds, mutual funds, ETFs, real estate, and other asset classes to optimize returns and minimize volatility. After finalizing your financial plan and investment strategy, your financial planner will assist you in implementing the plan and putting your investment strategy into action. They will help you open investment accounts, transfer funds, and execute trades according to your plan's guidelines. They will also provide ongoing support and guidance to ensure that your investments remain aligned with your goals and objectives as market conditions change. Financial planning is an ongoing process that requires regular monitoring and review to ensure that your plan remains on track and continues to meet your evolving needs and objectives. Your financial planner will monitor your investment performance, review your financial goals, and adjust your plan as needed to address changes in your life circumstances, market conditions, or financial goals. They will provide regular updates and recommendations to help you stay on course and make adjustments as necessary to maximize your financial success. Working with a financial planner can be a valuable asset in preparing for investment. By assessing your financial situation, setting clear financial goals, developing a customized investment strategy, implementing your financial plan, and monitoring your progress over time, a financial planner can help you navigate the complexities of the financial markets and achieve your long-term financial objectives. Investment risk refers to the possibility of losing money or failing to achieve expected returns on an investment. All investments carry some level of risk, which can vary depending on factors such as the asset class, market conditions, and individual circumstances. Common types of investment risk include market risk, inflation risk, interest rate risk, credit risk, liquidity risk, and geopolitical risk. By understanding the different types of investment risk and how they can impact your portfolio, you can make informed decisions and take steps to mitigate risk effectively. Before making investment decisions, it's essential to assess your risk tolerance, your ability and willingness to withstand fluctuations in the value of your investments. Risk tolerance is influenced by factors such as your investment goals, time horizon, financial situation, and psychological makeup. A financial advisor or risk tolerance questionnaire can help you determine your risk tolerance level and identify an appropriate investment strategy that aligns with your comfort level and objectives. Understanding your risk tolerance can help you avoid taking on too much risk or being overly conservative in your investment approach. Diversification is a risk management strategy that involves spreading your investments across different asset classes, industries, sectors, and geographic regions to reduce the impact of any single investment or event on your portfolio. By diversifying your investments, you can potentially lower overall portfolio risk and increase the likelihood of achieving more consistent returns over time. Diversification can be achieved through a mix of stocks, bonds, mutual funds, ETFs, real estate, and other asset classes, as well as by rebalancing your portfolio regularly to maintain desired allocation targets. The relationship between risk and return is a fundamental concept in investing. Generally, higher levels of risk are associated with the potential for higher returns, while lower levels of risk are associated with lower potential returns. Investors must strike a balance between risk and return based on their individual goals, risk tolerance, and investment horizon. Understanding this trade-off can help you make informed decisions about asset allocation, investment selection, and portfolio construction to achieve your desired level of risk and return. Asset allocation is the process of determining how to distribute your investment portfolio across different asset classes such as stocks, bonds, and cash equivalents. Asset allocation is a critical factor in determining portfolio risk and return, as it can help you achieve diversification and manage risk effectively. By allocating your assets strategically based on your risk tolerance, investment goals, and time horizon, you can build a well-balanced portfolio that balances risk and return and enhances the likelihood of achieving your financial objectives. Stress testing involves simulating various market scenarios to assess how your portfolio may perform under different economic conditions or extreme events. Stress testing can help you identify potential vulnerabilities in your portfolio and make adjustments to mitigate risk and improve resilience. Consider conducting stress tests regularly to evaluate the impact of market shocks, interest rate changes, geopolitical events, or other factors on your portfolio's performance and adjust your investment strategy accordingly. Assessing investment risk and preparing for it are essential aspects of successful investing. By understanding investment risk, assessing your risk tolerance, diversifying your investments, understanding the relationship between risk and return, mitigating risk through asset allocation, and stress testing your portfolio, you can build a resilient investment portfolio that can withstand market fluctuations and help you achieve your long-term financial goals. Taxes can significantly impact investment returns, so it's essential to understand how different types of investments are taxed and how to minimize tax liabilities. Common types of investment taxes include capital gains tax, dividend tax, interest income tax, and tax on investment gains. By understanding the tax implications of your investment decisions, you can make informed choices to optimize after-tax returns and maximize your investment success. Implementing tax-efficient investment strategies can help minimize the impact of taxes on your investment returns. Strategies such as tax loss harvesting, asset location, and tax-deferred or tax-free investment accounts can help reduce taxable income, defer taxes, or eliminate taxes altogether on investment gains. By strategically managing your investments with tax efficiency in mind, you can keep more of your investment returns and achieve better overall outcomes. Retirement accounts, such as 401ks, IRAs, and Roth IRAs, offer valuable tax advantages that can help you build wealth and save for retirement more effectively. Contributions to traditional retirement accounts are typically tax-deductible, reducing taxable income in the year of contribution, while investment gains grow tax-deferred until withdrawal. Roth retirement accounts, on the other hand, offer tax-free withdrawals in retirement, making them an attractive option for tax-free growth and income in retirement. Asset location refers to the placement of different types of investments in taxable and tax-advantaged accounts to optimize after-tax returns. Generally, tax-efficient investments, such as stocks with lower dividend yields or tax-free municipal bonds, are best held in taxable accounts, while tax-inefficient investments, such as bonds with higher interest income or real estate investment trusts (REITs), are better suited for tax-advantaged retirement accounts. By strategically locating your assets, you can minimize taxable income and maximize after-tax returns. Tax planning involves proactively managing your finances to minimize tax liabilities and maximize tax benefits. Effective tax planning strategies may include timing capital gains and losses, optimizing deductions and credits, and taking advantage of tax-advantaged investment opportunities. By working with a qualified tax advisor or financial planner, you can develop a personalized tax plan tailored to your unique financial situation, goals, and objectives. Tax laws and regulations are subject to change, so it's essential to stay informed about developments that may impact your investment taxes. Changes in tax rates, deductions, credits, and investment rules can affect your investment strategy and tax planning decisions. Regularly review your investment portfolio and tax situation in light of new tax laws, and seek professional advice as needed to ensure that you're optimizing your tax strategy and minimizing tax liabilities. An investment journal is a powerful tool for investors to track their investment decisions, document their thought process, and reflect on their successes and failures. It serves as a personal record of your investment journey, helping you analyze past decisions, identify patterns, and make more informed decisions in the future. By creating and maintaining an investment journal, you can improve your investment skills, refine your strategy, and increase your chances of achieving your financial goals. The first step in creating an investment journal is to record your investment decisions in detail. For each investment, write down the rationale behind your decision, including your investment thesis, research findings, and analysis of the potential risks and rewards. Document key metrics such as the investment's price, date of purchase, quantity, and any relevant market or economic factors influencing your decision. By documenting your investment decisions, you can track your progress over time and learn from both your successes and failures. An investment journal allows you to track the performance of your investment portfolio over time. Regularly update your journal with information on the value of your investments, changes in asset allocation, and overall portfolio performance. Include details such as investment returns, dividend income, capital gains or losses, and any fees or expenses incurred. By monitoring your portfolio's performance, you can assess the effectiveness of your investment strategy, identify areas for improvement, and make adjustments as needed to stay on track toward your financial goals. Periodically review your investment journal to analyze the outcomes of your investment decisions. Reflect on the factors that contributed to your successes and failures, and consider how you can replicate successful strategies or avoid repeating past mistakes. Look for patterns or trends in your investment performance, such as sectoral biases, timing issues, or behavioral biases, and adjust your approach accordingly. By conducting a thorough analysis of your investment outcomes, you can refine your investment strategy and increase your chances of success in the future. An investment journal is a valuable tool for learning and self-improvement. Use your journal to document lessons learned from your investment experiences, including insights into market dynamics, behavioral biases, and risk management strategies. Capture any new information or perspectives gained from research, conversations with advisors, or market developments. By continuously learning and adapting based on your experiences, you can enhance your investment skills, build confidence in your decision-making abilities, and achieve better outcomes over time. Consistency is key to the effectiveness of an investment journal. Make it a habit to update your journal regularly and thoroughly, even when market conditions are challenging or when investments underperform. Treat your journal as a personal accountability tool, holding yourself accountable for your investment decisions and their outcomes. Reviewing your journal regularly can help reinforce discipline, keep you focused on your long-term objectives, and prevent impulsive or emotional decision-making. Stocks, also known as shares or equities, represent ownership stakes in publicly traded companies. When you buy a stock, you become a partial owner of the company and are entitled to a share of its profits, known as dividends, as well as the potential for capital appreciation. Stocks are one of the most common and accessible investment vehicles, offering investors the opportunity to participate in the growth and success of businesses across various industries and sectors. The stock market is where stocks are bought and sold. Companies issue stocks through initial public offerings (IPOs) to raise capital from investors. Once listed on stock exchanges, such as the New York Stock Exchange (NYSE) or Nasdaq, stocks can be traded among investors. Stock prices are determined by supply and demand dynamics in the market, influenced by factors such as company performance, economic conditions, industry trends, and investor sentiment. There are different types of stocks, each with its characteristics and risk-return profiles. Common stocks are the most prevalent type of stock and offer voting rights and dividends. Preferred stocks, on the other hand, typically do not have voting rights, but may offer fixed dividends and priority claim on assets in the event of liquidation. Growth stocks are shares of companies expected to grow revenue and earnings at an above-average rate, while value stocks are undervalued relative to their fundamentals and may offer opportunities for long-term appreciation. Stock prices can be influenced by a wide range of factors, including company-specific news, industry trends, macroeconomic indicators, geopolitical events, changes in interest rates, and investor sentiment. Market participants, including individual investors, institutional investors, and algorithmic traders, analyze these factors to make informed investment decisions and attempt to predict future price movements. Investing in stocks involves various risks, including market risk, company-specific risk, sector risk, liquidity risk, and geopolitical risk. Stock prices can be volatile and subject to fluctuations, leading to potential losses for investors. However, stocks historically have offered higher returns over the long term compared to other asset classes, making them an essential component of a diversified investment portfolio. There are different strategies for investing in stocks, depending on an investor's goals, risk tolerance, and investment horizon. Some investors may adopt a buy and hold approach, focusing on long-term growth and dividends, while others may engage in active trading, seeking to profit from short-term price movements. Value investing, growth investing, dividend investing, and momentum investing are among the popular Strategies used by investors to select stocks and manage portfolios. Stocks represent ownership stakes in publicly traded companies and offer investors the opportunity to participate in the growth and success of businesses. Understanding how stocks work, the types of stocks available, factors affecting stock prices, associated risks, and investment strategies can help investors make informed decisions and build wealth over the long term. Bonds are fixed income securities issued by governments, municipalities, or corporations to raise capital. When investors purchase bonds, they are essentially lending money to the bond issuer in exchange for periodic interest payments, known as coupon payments, and the return of the principal amount, or face value, at maturity. Bonds are commonly used by investors seeking stable income streams and preservation of capital. Bonds have several key principles that investors should understand before investing. These include the face value, coupon rate, maturity date, and credit quality of the bond. The face value, or par value, represents the amount of money the bond issuer promises to repay to the bondholder at maturity. The coupon rate is the annual interest rate paid on the bond, expressed as a percentage of the face value. The maturity date is the date on which the bond issuer repays the principal amount to the bondholder. The credit quality of the bond reflects the issuer's ability to meet its financial obligations, with higher quality bonds typically offering lower yields but greater security. There are various types of bonds available to investors, each with its own characteristics and risk-return profiles. Government bonds are issued by national governments to finance government spending and infrastructure projects. They are considered among the safest investments because they are backed by the full faith and credit of the issuing government. Government bonds can include treasury bonds, treasury notes, and treasury bills, depending on their maturity. Corporate bonds are issued by corporations to raise capital for business expansion, acquisitions, or other corporate purposes. Corporate bonds offer higher yields compared to government bonds but also carry higher credit risk, as they are subject to the financial health and performance of the issuing corporation. Municipal bonds, or munis, are issued by state and local governments to fund public projects such as schools, highways, and utilities. Municipal bonds offer tax advantages, as interest income from municipal bonds is typically exempt from federal income tax and may be exempt from state and local taxes for investors residing in the issuing municipality. High-yield bonds, also known as junk bonds, are issued by companies with lower credit ratings or higher default risk. These bonds offer higher yields to compensate investors for the increased risk of default. Convertible bonds allow bondholders to convert their bonds into a predetermined number of common stock shares at a specified conversion price. Convertible bonds offer investors the opportunity to participate in potential stock price appreciation, while providing downside protection through the bond's fixed income characteristics. Real estate investment involves purchasing, owning, managing, renting, or selling properties for the purpose of generating income or achieving capital appreciation. Real estate is a tangible asset class that offers investors the opportunity to diversify their investment portfolios and potentially earn attractive returns over the long term. Real estate investments can be broadly categorized into residential and commercial properties, each offering unique advantages and considerations for investors. Residential real estate includes single-family homes, condominiums, townhouses, and multifamily apartment buildings. Investing in residential properties can provide steady rental income, potential tax benefits, and the opportunity for property appreciation over time. Residential properties are often considered less volatile than commercial properties and may appeal to investors seeking stable cash flow and long-term growth potential. Commercial real estate encompasses office buildings, retail centers, industrial warehouses, and mixed-use developments. Commercial properties typically generate higher rental income compared to residential properties, but may also entail higher operating costs and greater tenant turnover. Investing in commercial real estate requires careful analysis of market trends, lease agreements, tenant creditworthiness, and property management considerations. Before investing in real estate, investors should consider several key factors to assess the potential risks and rewards of their investment. Location is a critical determinant of real estate value and investment performance. Factors such as proximity to amenities, transportation hubs, employment centers, schools, and desirable neighborhoods can significantly impact property demand, rental rates, and resale value. Market conditions including supply and demand dynamics, vacancy rates, rental trends, and economic indicators influence real estate investment opportunities. Conducting thorough market research and due diligence can help investors identify favorable investment markets and mitigate downside risks. Real estate investors have various financing options available, including conventional mortgages, government-insured loans, private financing, and creative financing strategies. Evaluating financing terms, interest rates, loan-to-value ratios, and repayment terms is essential in structuring a sound investment strategy and maximizing returns. Real estate investing involves inherent risks, including property market fluctuations, tenant turnover, economic downturns, and unexpected expenses. Implementing risk management strategies such as diversification, property insurance, contingency reserves, and proactive property maintenance can help investors mitigate risks and safeguard their investment portfolios. Commodities are raw materials or primary agricultural products that are bought and sold in bulk on commodity exchanges. Investing in commodities allows investors to gain exposure to tangible assets and diversify their investment portfolios. Commodities are traded globally and include a wide range of products such as precious metals, energy resources, agricultural products, and industrial metals. Commodities can be broadly categorized into several major groups based on their characteristics and usage. Precious metals such as gold, silver, platinum, and palladium have intrinsic value and are often used as stores of value or hedges against inflation. Investing in precious metals can provide diversification benefits and serve as a safe haven during times of economic uncertainty. Energy commodities include crude oil, natural gas, heating oil, and gasoline. Energy commodities play a crucial role in global economies and are essential for transportation, heating, and industrial production. Investing in energy commodities can be influenced by geopolitical events, supply and demand dynamics, and energy policy decisions. Agricultural commodities comprise crops such as corn, wheat, soybeans, coffee, sugar, and cotton. Agricultural commodities are subject to weather conditions, crop yields, supply chain disruptions, and global trade dynamics. Investing in agricultural commodities can offer diversification benefits and opportunities for profit from changes in supply and demand fundamentals. Industrial commodities include metals such as copper, aluminum, zinc, and nickel. Industrial metals are used in manufacturing, construction, and infrastructure development. Investing in industrial metals can be influenced by industrial production trends, technological advancements, and global economic growth prospects. Investors can gain exposure to commodities through various investment vehicles, including futures contracts, exchange-traded funds ETFs, commodity mutual funds, and commodity-specific stocks. Each investment vehicle offers unique advantages and considerations in terms of liquidity, risk exposure, and cost efficiency. Commodities prices are influenced by a variety of factors, including supply and demand fundamentals, geopolitical events, global economic trends, currency fluctuations, and weather conditions. Understanding these factors and conducting thorough market analysis is essential for making informed investment decisions in commodities markets. Commodities investing carries inherent risks, including price volatility, geopolitical instability, regulatory changes, and commodity-specific risks. Implementing risk management strategies such as diversification, hedging, and position sizing can help investors mitigate downside risks and enhance portfolio resilience. Currency markets, also known as foreign exchange forex markets, facilitate the buying and selling of currencies from different countries. Currency trading is one of the largest and most liquid financial markets globally, with trillions of dollars traded daily. Investors participate in currency markets for various reasons, including speculation, hedging, and diversification. Currency trading involves the exchange of one currency for another at an agreed-upon exchange rate. Currency pairs are quoted in terms of the base currency and the quote currency, with the exchange rate representing the price at which one currency can be exchanged for another. Major currency pairs, such as EUR or USD, GBP or USD, and USD or JPY, are the most actively traded pairs in the forex market. Currency prices are influenced by a variety of factors, including interest rates, economic indicators, geopolitical events, central bank policies, and market sentiment. Understanding these factors and their impact on currency markets is essential for developing effective trading strategies and managing currency-related risks. There are several common trading strategies employed by currency traders to profit from fluctuations in exchange rates. Trend trading involves identifying and following established trends in currency prices. Traders may use technical analysis tools such as moving averages, trend lines, and momentum indicators to identify trend direction and entry or exit points. Range trading involves trading within a defined price range or consolidation phase. Traders may buy near support levels and sell near resistance levels, with the expectation that prices will continue to oscillate within the range. Breakout trading involves entering positions when currency prices break above or below key support or resistance levels. Traders aim to capitalize on the momentum generated by the breakout and ride the trend in the direction of the breakout. Carry trading involves borrowing funds in a low-yielding currency and investing in a higher-yielding currency to capture the interest rate differential, or carry. Carry trades are based on the expectation of earning interest income from the interest rate differential while benefiting from potential currency appreciation. Currency trading carries inherent risks, including market volatility, leverage magnification, geopolitical risks, and unexpected news events. Implementing risk management techniques such as stop-loss orders, position sizing, and diversification can help traders mitigate losses and preserve capital in volatile market conditions. Alternative investments refer to investment vehicles beyond traditional stocks, bonds, and cash equivalents. These investments often exhibit non-traditional return profiles and may include hedge funds, private equity, venture capital, real estate investment trusts (REITs), commodities, and collectibles. Alternative investments offer diversification benefits and the potential for higher returns, but also entail higher risks and may have limited liquidity. Hedge funds are private investment funds that pool capital from accredited investors and employ various investment strategies to generate returns. Hedge fund strategies can include long or short equity, global macro, event-driven, quantitative, and distressed debt, among others. Hedge funds often use leverage and derivatives to enhance returns and may charge performance fees based on their investment performance. Venture capital refers to private equity investments made in early-stage or emerging companies with high growth potential. Venture capital firms provide capital, expertise, and strategic guidance to startup companies in exchange for an ownership stake. Venture capital investments are typically high-risk, high-reward opportunities, and may involve longer investment horizons compared to traditional investments. Private equity involves investments in privately held companies through the acquisition of equity stakes. Private equity firms raise capital from institutional investors and high-net-worth individuals to finance leveraged buyouts, growth capital investments, and distressed asset acquisitions. Private equity investments aim to enhance company performance, create value through operational improvements, and achieve attractive returns upon exit through initial public offerings or mergers and acquisitions. REITs are publicly traded companies that own, operate, or finance income-generating real estate properties. REITs provide investors with exposure to real estate assets without the need for direct property ownership. REITs may specialize in various property sectors including residential, commercial, industrial, and healthcare real estate, and distribute a significant portion of their taxable income to shareholders in the form of dividends. Alternative investments also include tangible assets such as commodities, for example, precious metals, energy resources, and collectibles, for example, art, wine, rare coins. Investing in commodities and collectibles can offer portfolio diversification and potential inflation hedging benefits, but may involve storage costs, insurance considerations, and market liquidity risks. Cryptocurrencies are digital or virtual currencies that use cryptography for security and operate on decentralized networks based on blockchain technology. Bitcoin, introduced in 2009 by an anonymous person or group known as Satoshi Nakamoto, was the first cryptocurrency and remains the most well-known and widely traded. Since then, thousands of alternative cryptocurrencies, often referred to as altcoins, have been created, each with its unique features and use cases. Cryptocurrencies operate on decentralized networks that rely on distributed ledger technology, typically a blockchain, to record and verify transactions. Unlike traditional fiat currencies issued by governments and central banks, cryptocurrencies are not controlled by any single entity and are typically immune to government interference or manipulation. Cryptocurrencies enable peer-to-peer transactions without the need for intermediaries, offering greater transparency, security, and censorship resistance. Investing in cryptocurrencies involves purchasing digital assets with the expectation that their value will appreciate over time. Cryptocurrency investors may buy and hold coins as a long-term investment strategy, trade actively to profit from short-term price fluctuations, or engage in decentralized finance protocols to earn interest, provide liquidity, or participate in yield farming. Cryptocurrencies can be broadly categorized into several types based on their intended use case and underlying technology. Bitcoin and other payment coins such as Litecoin, Bitcoin Cash, and Dash are designed primarily for peer-to-peer transactions and store-of-value purposes. These cryptocurrencies aim to offer fast, secure, and low-cost payments without the need for traditional financial intermediaries. Smart contract platforms such as Ethereum, Binance Smart Chain, and Cardano enable developers to build decentralized applications and execute programmable smart contracts. These platforms facilitate token creation, decentralized finance protocols, non-fungible tokens, and other blockchain-based innovations. Privacy-focused cryptocurrencies such as Monero, Cash, and Dash prioritize user privacy and anonymity. By employing advanced cryptographic techniques such as ring signatures, snarks, and CoinJoin to obfuscate transaction details. Cryptocurrency investing carries inherent risks, including price volatility, regulatory uncertainty, cybersecurity threats, and market manipulation. Investors should conduct thorough research, exercise caution, and diversify their investment portfolios to mitigate risks associated with cryptocurrency investments. Investing in art and collectibles involves acquiring tangible assets such as fine art, rare collectibles, antiques, and other valuable items with the expectation of capital appreciation over time. Art and collectibles can offer investors diversification benefits, aesthetic enjoyment, and potential inflation hedging properties. However, investing in this asset class requires specialized knowledge, careful due diligence, and an understanding of market dynamics. Art and collectibles encompass a wide range of categories, including paintings, sculptures, ceramics, jewelry, rare books, stamps, coins, vintage cars, and memorabilia. Each category has its unique characteristics, market dynamics, and investment considerations. Fine art, for example, may appreciate in value based on the artist's reputation, historical significance, provenance, condition, and market demand. The prices of art and collectibles are influenced by various factors, including artistic merit, rarity, authenticity, provenance, cultural significance, aesthetic appeal, and market trends. Art market dynamics can be subjective and influenced by factors such as art market cycles, auction results, art fairs, gallery exhibitions, and collector preferences. Investors in art and collectibles can adopt different investment strategies based on their investment goals, risk tolerance, and time horizon. Some buy and hold. Investors acquire art and collectibles with the intention of holding them for the long term, expecting their value to appreciate over time. This strategy requires careful selection of high-quality assets with strong investment potential and patience to weather market fluctuations. Diversification involves spreading investment capital across multiple art and collectible categories, artists, or genres to reduce concentration risk and enhance portfolio resilience. Diversification can help investors mitigate the impact of individual asset underperformance and capitalize on emerging market trends. Active trading involves buying and selling art and collectibles based on short-term market trends, price movements, and opportunistic buying opportunities. Active traders may leverage market analysis, expert advice, and auction data to identify undervalued assets and capitalize on market inefficiencies. Art and collectibles investing carry inherent risks, including market volatility, illiquidity, authenticity concerns, valuation challenges, and storage or security considerations. Implementing risk management strategies such as thorough due diligence, insurance coverage, professional appraisals, and proper storage facilities can help investors mitigate potential risks and protect their investment portfolios. Investing in technology startups and innovations involves providing capital to early-stage companies with disruptive technologies or business models. Technology startups are known for their potential to deliver significant returns on investment but also carry high risks due to their unproven concepts and uncertain market traction. Despite the risks, investing in technology startups offers opportunities to participate in groundbreaking innovations and disruptive technologies that have the potential to reshape industries. Assessing the market potential and scalability of a technology startup's product or service is crucial. Investors should evaluate the target market size, growth prospects, competitive landscape, and barriers to entry to determine the startup's growth potential and market fit. The management team and leadership of a technology startup play a critical role in its success. Investors should evaluate the founder's expertise, industry experience, vision, and ability to execute the business plan effectively. A strong and experienced team increases the startup's likelihood of overcoming challenges and achieving milestones. Evaluating the uniqueness and defensibility of the startup's technology and intellectual property portfolio is essential. Investors should assess whether the startup's technology offers a competitive advantage, intellectual property protection, and potential for innovation and differentiation in the market. Analyzing the startup's financials, revenue projections, burn rate, and fundraising history provides insights into its financial health and capital requirements. Investors should evaluate the startup's funding needs, fundraising strategy, and valuation expectations to determine the investment opportunity's attractiveness and potential return on investment. Angel investors provide early-stage funding to startups in exchange for equity ownership. Angel investors often play an active role in mentoring, advising, and connecting startups with resources and networks to support their growth. Venture capital firms invest institutional capital in high-growth startups with the potential to deliver significant returns. VC firms typically provide financing through multiple rounds of funding, from seed stage to Series A, B, and beyond, and may offer strategic guidance, networking opportunities, and operational support to portfolio companies. Corporate venture capital programs involve established corporations investing in startups that align with their strategic objectives and business interests. CVC investments offer startups access to corporate resources, industry expertise, and potential partnerships or acquisition opportunities. Investing in technology startups carries inherent risks, including market volatility, product development challenges, competition, regulatory uncertainty, and execution risks. Trading in financial markets involves buying and selling financial instruments such as stocks, bonds, currencies, commodities, and derivatives with the aim of generating profits from price movements. Financial market trading encompasses a wide range of participants, including individual traders, institutional investors, hedge funds, and proprietary trading firms. Successful trading requires knowledge of market dynamics, risk management, and effective trading strategies. Traders analyze financial markets using fundamental analysis, technical analysis, or a combination of both. Fundamental analysis involves evaluating economic indicators, company financials, and market trends to assess the intrinsic value of assets. Technical analysis focuses on studying price charts, patterns, and indicators to identify trends, support or resistance levels, and potential entry-exit points. Effective risk management is essential for preserving capital and managing trading losses. Risk management techniques such as position sizing, stop-loss orders, and diversification help traders mitigate potential losses and protect against adverse market movements. Trading platforms provide access to financial markets and execution tools for placing trades, managing positions, and analyzing market data. Traders can choose from a variety of trading platforms, including online brokerage platforms, direct market access DMA platforms, and specialized trading software. Traders can use different order types to execute trades based on specific criteria and objectives. Common order types include market orders, limit orders, stop orders, and conditional orders. Each order type has its advantages and considerations, depending on the trading strategy and market conditions. Day trading. Day traders buy and sell financial instruments within the same trading day, aiming to profit from intraday price movements. Day trading strategies often involve technical analysis, short-term price patterns, and high-frequency trading techniques. Swing trading. Swing traders hold positions for several days to weeks, capitalizing on short to medium-term price swings and trends. Swing trading strategies focus on identifying and trading within the broader market trends and momentum patterns. Position trading. Position traders hold positions for weeks to months based on longer-term market trends and fundamental analysis. Position trading strategies aim to capture significant price movements and trends over extended timeframes. often requiring patience and discipline. Algorithmic trading. Algorithmic trading, also known as automated trading or algo trading, involves using computer algorithms to execute trades automatically based on predefined rules and criteria. Algorithmic trading strategies may incorporate quantitative analysis, statistical models, and machine learning techniques to identify trading opportunities and manage risk. Trading in financial markets carries inherent risks, including market volatility, execution risks, liquidity constraints, and regulatory compliance issues. Traders should develop robust trading plans, adhere to disciplined risk management practices, and continuously monitor market conditions to navigate the challenges of financial market trading successfully. Investment funds, also known as mutual funds or collective investment schemes, pool money from multiple investors to invest in a diversified portfolio of securities, such as stocks, bonds, or other assets. Investment funds are managed by professional fund managers or investment firms, who make investment decisions on behalf of the fund's investors. Investment funds offer individual investors access to diversified investment portfolios, professional management, and the potential for returns based on the fund's performance. Equity funds invest primarily in stocks or equity securities, aiming to achieve capital appreciation over the long term. Equity funds may focus on specific sectors, regions, or investment styles, such as growth, value, or dividend investing. Fixed income funds invest in bonds, debt securities, or other fixed income instruments, seeking to generate income through interest payments and capital preservation. Fixed income funds may include government bonds, corporate bonds, municipal bonds, and high-yield bonds with varying levels of credit risk and duration. Balanced funds, also known as asset allocation or hybrid funds, invest in a mix of stocks, bonds, and other asset classes to achieve a balance between growth and income objectives. Balanced funds offer diversification benefits and may adjust asset allocations based on market conditions and investment goals. Index funds replicate the performance of a specific market index, such as the S&P 500 or the FTSE 100. By holding a portfolio of securities that closely mirrors the index's composition. Index funds aim to match the returns of the underlying index, and typically have lower management fees compared to actively managed funds. Benefits of investment funds. Diversification. Investment funds offer investors access to diversified portfolios of securities, reducing individual stock or bond-specific risks and enhancing portfolio stability. Professional management. Investment funds are managed by experienced fund managers or investment professionals who conduct research, analysis, and portfolio management on behalf of investors. Liquidity. Most investment funds offer daily liquidity, allowing investors to buy or sell fund shares on any business day at the fund's current net asset value. Cost efficiency. Investment funds pool assets from multiple investors, allowing for economies of scale and lower transaction costs compared to individual investing. Considerations for investing in investment funds. Performance track record. Investors should evaluate the historical performance of investment funds relative to their benchmarks and peer group to assess the fund's track record and consistency of returns. Fees and expenses. Investors should consider the fees and expenses associated with investment funds, including management fees, administrative expenses, and sales charges loads, to understand the total cost of investing in the fund. Investment objectives and risk profile. Investors should align their investment objectives, time horizon, and risk tolerance with the investment fund's objectives, asset allocation, and risk profile. Tax implications. Investors should be aware of the tax implications of investing in investment funds, including capital gains taxes, dividend distributions, and tax-efficient investment strategies. Investing in exchange-traded funds (ETFs) has become increasingly popular among investors seeking diversified exposure to various asset classes with added flexibility and cost efficiency. ETFs combine the features of both stocks and mutual funds, offering investors a convenient way to access diversified investment portfolios while trading on stock exchanges like individual stocks. Let's delve into the basics of ETFs and explore their advantages. Structure: ETFs are investment funds that pool money from multiple investors to invest in a diversified portfolio of assets such as stocks, bonds, commodities, or real estate. Unlike mutual funds, which are priced once a day at the end of the trading day, ETFs trade throughout the day on stock exchanges at market prices, providing intraday liquidity to investors. Creation and redemption: ETF shares are created and redeemed by authorized participants, typically large institutional investors, who exchange baskets of securities with the ETF issuer in exchange for ETF shares or vice versa. This creation or redemption mechanism helps maintain the ETF's market price close to its net asset value (NAV) and ensures efficient price discovery in the secondary market. Types of ETFs: ETFs come in various types, including equity ETFs, bond ETFs, commodity ETFs, sector ETFs, thematic ETFs, and international ETFs, catering to different investment objectives and preferences. Some ETFs replicate the performance of specific market indices, while others follow active management strategies or employ alternative investment approaches. Considerations for investing in exchange-traded funds ETFs. Trading costs: while ETFs offer intraday liquidity, investors should be mindful of trading costs, including brokerage commissions and bid-ask spreads, which can affect the overall cost of investing in ETFs, especially for frequent traders. Tracking error: ETFs that replicate the performance of market indices may experience tracking error, which is the deviation of the ETF's returns from the index's returns, due to factors such as expenses, trading costs, and sampling methodology. Tax efficiency: although ETFs are generally tax-efficient investment vehicles, investors should be aware of potential capital gains distributions and tax implications associated with buying and selling ETF shares in taxable accounts. Unit investment trusts (UTs) are a type of investment fund that pools money from investors to purchase a fixed portfolio of securities, typically consisting of stocks, bonds, or other income-producing assets. UTs are established under a trust agreement and have a fixed termination date, after which the trust is dissolved, and the underlying assets are sold and distributed to investors. UTs offer investors a convenient way to gain exposure to a diversified portfolio of securities, while benefiting from professional management and administrative services provided by the trust sponsor or manager. Types of unit investment trusts. Equity UTs. Equity UTs invest in a portfolio of stocks or equity securities aiming to achieve capital appreciation over the long term. Equity UTs may focus on specific sectors, industries, or market capitalizations, providing investors with exposure to different segments of the equity market. Fixed income UTs. Fixed income UTs invest in a portfolio of bonds, debt securities, or other fixed income instruments, seeking to generate income through interest payments and capital preservation. Fixed income UTs may include government bonds, corporate bonds, municipal bonds, and mortgage-backed securities with varying levels of credit risk and maturity profiles. Mixed UTs. Mixed UTs, also known as balanced or hybrid UTs, invest in a combination of stocks, bonds, and other asset classes to achieve a balanced investment strategy. Mixed UTs offer diversification benefits and may adjust asset allocations based on market conditions and investment objectives. Strategies for investing in unit investment trusts. Diversification. Investing in a diversified portfolio of securities through a UIT can help spread risk and reduce exposure to individual company or sector-specific risks. Income generation. Fixed income UTs can provide investors with a source of regular income through interest payments generated by the underlying bond holdings. Capital appreciation. Equity UTs offer the potential for capital appreciation over the long term, as the value of the underlying stocks or equity securities appreciates. Tax efficiency. UTs may offer tax advantages such as tax-deferred income and capital gains treatment, depending on the type of securities held and the structure of the trust. Risks associated with unit investment trusts. Market risk. UTs are subject to market fluctuations and volatility, which can affect the value of the underlying securities and the overall performance of the trust. Interest rate risk. Fixed income UTs are sensitive to changes in interest rates, with bond prices typically inversely correlated to interest rate movements. Rising interest rates can lead to a decline in bond prices and potential capital losses for bondholders. Credit risk. Fixed income UTs that invest in lower-rated or speculative-grade bonds are exposed to credit risk, the risk of default or credit deterioration by bond issuers, which can result in losses for investors. Liquidity risk. UTs may have limited liquidity, especially for less actively traded or illiquid securities held in the trust's portfolio, which can impact the ability to buy or sell units at fair market prices. Index funds are a type of investment fund that seeks to replicate the performance of a specific market index, such as the S&P 500 or the FTSE 100, by holding a diversified portfolio of securities that closely mirrors the index's composition. Index funds aim to provide investors with broad market exposure, low costs, and consistent returns over the long term by tracking the performance of a benchmark index. Key features of index funds. Passive management. Index funds adopt a passive investment strategy, aiming to match the returns of the underlying index rather than outperforming it. Fund managers focus on closely tracking the index's performance by holding a representative sample of securities in the same proportions as the index. Diversification. Index funds offer investors exposure to a diversified portfolio of securities across various sectors, industries, and asset classes included in the underlying index. Diversification helps spread risk and reduces the impact of individual stock or sector-specific fluctuations on the fund's overall performance. Low costs. Index funds typically have lower management fees and operating expenses compared to actively managed funds, as they require minimal research, trading, and portfolio management. Low costs contribute to higher net returns for investors over time, especially in the context of compounding investment growth. Tax efficiency. Index funds tend to generate fewer taxable capital gains distributions compared to actively managed funds, as they have lower portfolio turnover and reduced trading activity. Tax-efficient investment strategies help minimize tax liabilities for investors, enhancing after-tax returns. Advantages of investing in index funds. Broad market exposure. Index funds provide investors with exposure to the overall performance of the market, or specific segments of the market represented by the underlying index. Cost-effective investing. Index funds offer cost-effective investment solutions with low management fees, expense ratios, and trading costs, making them suitable for long-term investors seeking to maximize returns and minimize expenses. Consistent performance. Index funds aim to replicate the returns of the underlying index over time, delivering consistent and predictable investment results aligned with market trends and economic cycles. simplicity and accessibility. Index funds are easy to understand and access, making them suitable for novice investors and those seeking a hands-off approach to investing. Investors can purchase index fund shares through brokerage accounts, retirement plans, and investment platforms with minimal effort. Considerations for investing in index funds. Index selection. Investors should consider the selection criteria, methodology, and composition of the underlying index when choosing an index fund, ensuring alignment with their investment objectives, risk tolerance, and portfolio diversification needs. Tracking error. Index funds may deviate slightly from the performance of the underlying index due to tracking error, resulting from factors such as management fees, trading costs, and portfolio rebalancing. Investors should assess the fund's tracking error and performance relative to the benchmark index. Asset allocation. Index funds can serve as core holdings within a diversified investment portfolio, complementing actively managed funds, individual stocks, or alternative investments to achieve optimal asset allocation and risk-adjusted returns. Pension funds are investment pools established to provide retirement benefits to employees or members of a pension plan. These funds receive contributions from employees, employers, or both, which are then invested in a diversified portfolio of assets to generate returns over the long term. Pension funds play a crucial role in retirement planning by helping individuals accumulate savings and build wealth to support their financial needs during retirement. Structure of pension funds. Trust structure. Pension funds are typically structured as trusts, with a board of trustees responsible for overseeing fund operations, investment decisions, and compliance with regulatory requirements. The trustees have a fiduciary duty to act in the best interests of the plan participants and beneficiaries. Investment committee. Pension funds may have an investment committee composed of investment professionals, financial experts, and representatives from the plan sponsor or employer. The investment committee is responsible for setting investment policies, asset allocation strategies, and monitoring investment performance. Custodian and asset managers. Pension funds often appoint a custodian bank to safeguard fund assets, process transactions, and provide custody services. Asset managers or investment firms are hired to manage the fund's investment portfolio, select securities, and implement investment strategies based on the fund's objectives and risk tolerance. Functions of pension funds. Wealth accumulation. Pension funds help individuals accumulate savings for retirement by investing contributions in a diversified portfolio of assets, such as stocks, bonds, real estate, and alternative investments. The compounding effect of investment returns over time allows pension funds to grow assets and build retirement wealth. Risk management. Pension funds employ asset allocation strategies and diversification techniques to manage investment risks and preserve capital. By spreading investments across different asset classes and geographic regions, pension funds aim to reduce portfolio volatility and mitigate the impact of market fluctuations on fund performance. Income generation. Pension funds seek to generate income through interest, dividends, and capital appreciation from their investment portfolios. Income generated by pension fund investments contributes to the funding of retirement benefits and helps sustain pension plan liabilities over time. Long-term sustainability. Pension funds focus on achieving long-term investment objectives to meet the future retirement needs of plan participants and beneficiaries. Fund managers employ disciplined investment practices, risk management techniques, and actuarial analysis to ensure the sustainability and solvency of pension plans. Real estate funds are investment vehicles that pool capital from multiple investors to invest in various real estate properties or real estate-related assets. These funds provide individuals with access to the real estate market without the need for direct property ownership. Real estate funds may focus on different types of properties, including residential, commercial, industrial, and retail real estate, offering investors a diversified portfolio of real estate assets. Key aspects of real estate funds: diversification. Real estate funds invest in a portfolio of properties across different sectors, locations, and property types, providing investors with diversification benefits and reducing exposure to specific property risks. Diversification helps spread risk and enhances the stability of returns in the real estate fund. Professional management. Real estate funds are managed by professional fund managers or real estate investment firms with expertise in property acquisition, management, and development. Fund managers conduct thorough due diligence, property analysis, and market research to identify investment opportunities and optimize portfolio performance. Liquidity options. Unlike direct real estate investments, which may lack liquidity and require significant time and effort to buy or sell properties, real estate funds offer investors liquidity options through regular redemption opportunities or secondary market trading. Investors can buy or sell fund shares based on their liquidity needs and investment preferences. Income generation. Real estate funds generate income for investors through rental income from leased properties, dividend distributions, and capital appreciation from property value appreciation. Rental income provides a stable source of cash flow, while capital appreciation reflects the increase in property values over time. Investment opportunities in real estate funds. Residential real estate funds. Residential real estate funds invest in single-family homes, multi-family apartment buildings, condominiums, and other residential properties. These funds offer investors exposure to the rental housing market and potential rental income streams. Commercial real estate funds. Commercial real estate funds focus on office buildings, retail centers, industrial warehouses, and other commercial properties. These funds target income-producing properties leased to businesses, offering investors stable cash flow and potential capital appreciation. Real estate investment trusts (REITs). Real estate investment trusts are publicly traded companies that own, operate, or finance income-producing real estate properties. REITs provide investors with access to diversified real estate portfolios and the potential for dividend income and capital appreciation through stock ownership. Robo-advisors are automated investment platforms that use algorithms and computer algorithms to provide investment advice and manage portfolios for investors. These digital platforms offer personalized investment solutions based on investors' financial goals, risk tolerance, and investment preferences. Robo-advisors have gained popularity for their accessibility, low fees, and ease of use, making them attractive options for both novice and experienced investors. Key features of robo-advisors: automated portfolio management. Robo-advisors utilize sophisticated algorithms to create and manage diversified investment portfolios tailored to individual investors' needs. The algorithms analyze various factors, including investment goals, time horizon, risk tolerance, and market conditions, to recommend suitable investment strategies and asset allocations. Low fees. Robo-advisors typically charge lower fees compared to traditional financial advisors and actively managed funds. By leveraging technology and automation, robo-advisors streamline the investment process and reduce overhead costs, allowing them to offer cost-effective investment solutions to investors. Diversified investment options. Robo-advisors provide access to a wide range of investment options, including stocks, bonds, exchange-traded funds (ETFs), and mutual funds. Investors can choose from pre-built portfolios or customize their investment preferences based on asset allocation, sector exposure, and risk profile. Goal-based investing. Robo-advisors focus on goal-based investing, where investors set specific financial goals such as retirement savings, education funding, or wealth accumulation. The platforms recommend investment strategies and portfolio allocations aligned with each goal, helping investors track progress and achieve their objectives over time. Role of robo-advisors in investing. Accessibility. Robo-advisors offer a user-friendly interface and intuitive investment tools, making investing accessible to a broader audience, including millennials, young professionals, and individuals with limited investment knowledge. The ease of use and convenience of robo-advisors encourage more people to start investing and build long-term wealth. Portfolio diversification. Robo-advisors emphasize diversification as a key investment strategy to manage risk and optimize returns. By spreading investments across different asset classes and geographic regions, robo-advisors help investors build diversified portfolios tailored to their risk tolerance and investment objectives. Financial planning. Robo-advisors provide comprehensive financial planning tools and resources to help investors set financial goals, create investment plans, and track progress over time. These platforms offer retirement planning calculators, investment calculators, and goal tracking features to empower investors to make informed financial decisions. Structured products are financial instruments created to meet specific investment objectives using derivatives. They typically combine a traditional security, such as a bond or a note, with one or more derivatives to offer customized payoff profiles. While structured products can provide unique opportunities for investors, they also come with inherent advantages and risks that individuals should carefully consider before investing. Advantages of structured products. Tailored investment solutions. Structured products can be customized to meet the unique needs and preferences of investors. By incorporating various derivatives and underlying assets, issuers can design structured products with specific risk-return profiles, income streams, or protection features to align with investors' objectives. Diversification benefits. Structured products often offer exposure to a diversified range of underlying assets, including equities, fixed income securities, commodities, or currencies. By diversifying across different asset classes and market sectors, structured products can help investors spread risk and potentially enhance portfolio returns. Downside protection. Some structured products incorporate downside protection mechanisms, such as principal protection or partial capital guarantees, to shield investors from losses in adverse market conditions. These features provide a level of downside protection and capital preservation, particularly in volatile market environments. Enhanced yield. Structured products may offer enhanced yield opportunities compared to traditional fixed income securities, such as bonds or certificates of deposit CDs. By leveraging derivatives to optimize cash flows and capture market opportunities, structured products can generate higher income potential for investors. Risks associated with structured products. Complexity. Structured products often feature complex payoff structures and embedded derivatives that may be challenging for investors to understand fully. The complexity of these products can obscure underlying risks and potential outcomes, leading to misunderstandings or misinterpretations by investors. Lack of liquidity. Many structured products have limited liquidity compared to traditional securities, making them difficult to buy or sell on secondary markets. Illiquid markets can result in wider bid-ask spreads, price volatility, and potential difficulty exiting positions, particularly in times of market stress. Credit risk. Structured products are typically issued by financial institutions or investment banks, exposing investors to credit risk associated with the issuer's financial stability and creditworthiness. In the event of issuer default or bankruptcy, investors may incur losses on their investments, including potential loss of principal. Market risk. Structured products are subject to market risk, including fluctuations in interest rates, equity prices, currency exchange rates, and commodity prices. Investing in international funds provides investors with exposure to global markets outside their home country. These funds allocate capital across various countries, regions, and sectors, offering diversification benefits and access to potential growth opportunities in international markets. Here, we'll explore strategies for investing in international funds and discuss their long-term perspectives. Strategies for investing in international funds. Diversification across geographies. International funds invest in a broad range of countries and regions, providing investors with geographical diversification. By spreading investments across different markets, investors can mitigate country-specific risks and capitalize on growth opportunities in both developed and emerging economies. Sector and industry exposure. International funds offer exposure to diverse sectors and industries that may not be available domestically. Investors can gain access to industries such as technology, healthcare, consumer goods, and financial services that drive economic growth and innovation in various parts of the world. Currency exposure and hedging. Investing in international funds exposes investors to currency fluctuations between their home currency and the currencies of the countries where fund assets are denominated. Investors may consider currency hedging strategies to manage currency risk and protect investment returns from adverse exchange rate movements. Emerging market opportunities. Some international funds focus on emerging market economies with high growth potential and dynamic demographics. Investing in emerging markets offers opportunities for higher returns, but also involves higher risks due to factors such as political instability, currency volatility, and regulatory uncertainties. Long-term perspectives on international fund investments. Global economic growth. International funds provide exposure to global economic growth trends, allowing investors to participate in the expansion of emerging markets and the resilience of developed economies. Long-term investors may benefit from diversifying their portfolios with international funds to capture growth opportunities worldwide. Geopolitical considerations. Geopolitical events and macroeconomic factors can impact international markets and influence investment outcomes. Investors should stay informed about geopolitical developments, trade policies, and regulatory changes in key regions to assess potential risks and opportunities in international fund investments. Portfolio diversification. International funds play a crucial role in portfolio diversification by reducing correlation with domestic assets and enhancing risk-adjusted returns. Diversified portfolios that include international funds are better positioned to withstand market volatility and capitalize on global investment opportunities. Currency risk management. Currency risk management is essential for international fund investors to mitigate the impact of currency fluctuations on investment returns. Hedging strategies, such as currency forwards or options, can help investors manage currency risk and stabilize portfolio performance in volatile currency markets. Investors have a plethora of investment fund options to choose from, each with its unique characteristics, objectives, and risk profiles. Understanding the differences between these funds and selecting the most suitable one requires careful consideration of several factors. In this section, we'll compare different types of investment funds and discuss strategies for choosing the right one for your investment goals. Comparing different types of investment funds. Mutual funds. Mutual funds pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. They offer professional management, diversification, and liquidity, making them suitable for investors seeking broad market exposure and long-term capital appreciation. Exchange-traded funds ETFs. ETFs are similar to mutual funds but trade on stock exchanges like individual stocks. They provide low-cost, transparent access to specific market segments, indices, or investment themes. ETFs offer intraday trading flexibility, tax efficiency, and low expense ratios, making them popular among passive and active investors alike. Index funds. Index funds track a specific market index, such as the S&P 500 or the FTSE 100, and aim to replicate its performance. They offer low-cost, diversified exposure to broad market segments, and are suitable for investors seeking market-matching returns with minimal fees and active management. Hedge funds. Hedge funds are alternative investment vehicles that employ various strategies, including long or short equity, arbitrage, and derivatives trading, to generate absolute returns irrespective of market conditions. They typically target high net worth individuals and institutional investors and may involve higher fees, lockup periods, and complex investment strategies. How to choose the right investment fund. Clarify your investment goals. Determine your investment objectives, time horizon, risk tolerance, and liquidity needs before selecting an investment fund. Different funds cater to specific goals, such as capital preservation, income generation, or long-term growth. So aligning your goals with the fund's objectives is crucial. Evaluate performance and track record. Assess the historical performance, risk-adjusted returns, and consistency of fund performance over various market cycles. Look for funds with a strong track record of delivering competitive returns relative to their benchmark indices and peers. Consider costs and fees. Compare the expense ratios, management fees, and other expenses associated with each investment fund. Lower-cost funds tend to outperform higher-cost funds over the long term. So prioritize funds with competitive fees and transparent fee structures. Review fund holdings and strategy. Understand the fund's investment strategy, asset allocation, and underlying holdings to ensure alignment with your investment objectives and risk preferences. Evaluate the fund's portfolio composition, sector exposure, and diversification to assess its suitability for your investment needs. Assess risks and volatility. Consider the risk profile and volatility of each investment fund, taking into account factors such as market risk, credit risk, and liquidity risk. Choose funds that align with your risk tolerance and investment horizon, and diversify across asset classes to manage overall portfolio risk. Seek professional advice if necessary. Consult with a financial advisor or investment professional to discuss your investment goals, risk tolerance, and fund selection criteria. A professional advisor can provide personalized recommendations and help you navigate the complexities of the investment landscape. By carefully evaluating the characteristics, performance, and suitability of different investment funds, investors can make informed decisions and construct well-diversified portfolios aligned with their financial goals and risk preferences. When it comes to investing, the world is your oyster, or should I say, your investment portfolio is your oyster. From stocks and bonds to real estate and commodities, there's a wide array of investment options to choose from. Let's dive into the wonderful world of investments and explore some of the most common types available. Stocks, the darlings of the investment world. When you buy a stock, you're essentially buying a tiny piece of ownership in a company. It's like being a shareholder in your favorite pizza joint, except instead of free slices, you get a share of the company's profits, hopefully. Stocks offer the potential for high returns but come with a side of volatility, so buckle up and get ready for a wild ride. If stocks are the rock stars of the investment world, then bonds are the steady eddies. When you buy a bond, you're essentially lending money to a government or corporation in exchange for regular interest payments and the return of your principal when the bond matures. It's like being the bank, except instead of charging interest, you're earning it. Bonds are prized for their stability and income-generating potential, making them a staple in many investors' portfolios. Who doesn't dream of owning their own piece of paradise? With real estate investing, that dream can become a reality. Whether it's residential properties, commercial buildings, or vacant land, real estate offers a tangible asset with the potential for appreciation and rental income. Just remember, being a landlord comes with its fair share of headaches, from leaky faucets to late-night tenant calls. But if you're willing to roll up your sleeves and get your hands dirty, real estate can be a lucrative investment opportunity. Mutual funds are like the Swiss Army knives of investing. They've got a little something for everyone. These pooled investment vehicles allow investors to buy into a diversified portfolio of stocks, bonds, or other assets managed by professional fund managers. It's like having a team of financial experts working around the clock to grow your money, all for a modest fee, of course. Mutual funds offer convenience, diversification, and professional management, making them a popular choice for many investors. Think of ETFs as the cooler, younger sibling of mutual funds. Like mutual funds, ETFs offer investors exposure to a diversified portfolio of assets, but with some added perks. Unlike mutual funds, which are bought and sold at the end of the trading day, ETFs trade on stock exchanges throughout the day, just like individual stocks. This liquidity and flexibility make ETFs a favorite among active traders and passive investors alike. Retirement, the golden years we all dream of. But if you want to retire in style, you'll need to start planning and saving early. Retirement accounts like 401ks and IRAs offer tax advantages and incentives to help you build a nest egg for your golden years. Whether you opt for a traditional 401k with tax-deferred contributions or a Roth IRA with tax-free withdrawals, these accounts are essential tools for long-term financial planning. From gold and oil to coffee and cocoa, commodities are the raw materials that power the global economy. Investing in commodities can be a hedge against inflation, currency fluctuations, and geopolitical uncertainty. Whether you're bullish on precious metals or bearish on agricultural commodities, there is a commodity investment out there for every investor. Welcome to the wild, wild world of cryptocurrencies, the digital frontier of investing. From Bitcoin to Ethereum, these digital assets have taken the world by storm, offering decentralized and secure transactions outside the traditional banking system. But beware, the crypto market is notoriously volatile, with prices soaring to dizzying heights one moment and crashing back to earth the next. Proceed with caution and only invest what you can afford to lose. Tired of playing by the bank's rules? Peer-to-peer lending might be just what you need. With P2P lending platforms like Lending Club and Prosper, you can lend money directly to individuals or small businesses in exchange for interest payments. It's like being the bank, but without all the red tape and bureaucracy. Just remember to do your due diligence and diversify your loans to minimize risk. From rare stamps and coins to vintage cars and artwork, collectibles are a unique and often overlooked investment opportunity. While they may not offer the same liquidity or income potential as stocks or bonds, collectibles can be a fun and rewarding way to diversify your portfolio. Just be sure to do your research and buy from reputable dealers to avoid getting burned. Investing is all about balancing risk and return, like walking a tightrope between opportunity and peril. In this section, we'll delve into the intricacies of risk and return and explore how they shape your investment decisions. Imagine you're planning a hiking trip in the mountains. The higher you climb, the more breathtaking the views, but also the greater the risk of a misstep and a tumble down the slope. Investing works much the same way. Higher risk investments like stocks and cryptocurrencies offer the potential for higher returns, but also come with a greater chance of losses. On the flip side, lower risk investments like bonds and savings accounts offer more stability but may provide lower returns over time. It's a delicate balancing act, finding the right mix of risk and return to match your financial goals and risk tolerance. Volatility, the roller coaster ride of the investment world. It's like being strapped into a runaway train, hurtling through peaks and valleys at breakneck speed. While volatility can be stomach-churning at times, it's also the engine that drives investment returns. Without volatility, there would be no opportunity for growth or profit. The key is learning to ride the waves of volatility without getting seasick, staying calm, cool, and collected when the market gets rocky. If there's one golden rule of investing, it's this: don't put all your eggs in one basket. Diversification is like building a sturdy fortress for your investments, spreading your money across a range of asset classes, sectors, and geographic regions to minimize risk and maximize returns. By diversifying your portfolio, you can cushion the blow of any one investment going south and keep your overall risk in check. It's like wearing a helmet and knee pads on your investment journey, protecting yourself from the inevitable bumps and bruises along the way. Time is money, especially in the world of investing. Your time horizon, or how long you plan to hold onto an investment, can have a big impact on your risk and return. If you're saving for retirement decades down the road, you can afford to take on more risk and ride out short-term fluctuations in the market. But if you're saving for a down payment on a house next year, you'll want to stick to safer, more stable investments. By matching your investments to your time horizon, you can optimize your returns and minimize your risk exposure. Liquidity is like the lifeblood of investing. It's what keeps the wheels of the market turning. Liquid investments can be bought and sold quickly and easily without significantly affecting their price. Think stocks, bonds, and ETFs. They're like the Usain Bolt of investments, ready to sprint to the finish line at a moment's notice. Illiquid investments, on the other hand, are like molasses in January, slow, sticky, and hard to move. While they may offer the potential for higher returns, illiquid investments can tie up your money for years and leave you high and dry when you need it most. Risk tolerance, the secret sauce of successful investing. It's like knowing your limits at an all-you-can-eat buffet. Some people can handle the heat of the spicy curry, while others stick to the mild salsa. Your risk tolerance is your ability and willingness to stomach the ups and downs of the market without losing sleep at night. By understanding your risk tolerance and building a portfolio that matches it, you can set yourself up for long-term success and avoid making impulsive decisions when the going gets tough. Emotions, the double-edged sword of investing. While they can be a source of inspiration and motivation, they can also lead us astray when it comes to making financial decisions. From fear and greed to overconfidence and regret, our emotions can cloud our judgment and cause us to make irrational decisions. The key is learning to recognize and manage our emotional biases, staying disciplined, sticking to our investment plan, and tuning out the noise of the market. After all, investing is a marathon, not a sprint, so keep calm and carry on. Investing without clear goals is like sailing without a compass. You might end up going in circles, or worse, getting lost at sea. In this section, we'll discuss the importance of setting investment goals and how to chart your financial course for success. Before you set sail on your investment journey, take some time to reflect on your financial goals, values, and priorities. Are you saving for retirement, a down payment on a house, or your child's education? Do you have a high tolerance for risk, or are you more conservative in your approach? By understanding your unique financial situation and goals, you can tailor your investment strategy to match. When it comes to setting investment goals, remember to be smart, specific, measurable, achievable, relevant, and time-bound. Instead of vague aspirations like "I want to be rich," try setting concrete goals like "I want to save $1 million for retirement by age 65. By breaking your goals down into bite-sized, actionable steps, you can track your progress and stay motivated along the way. Not all goals are created equal. Some are like sprint races, while others are more like marathons. Short-term goals, like saving for a vacation or buying a new car, require a different investment strategy than long-term goals, like saving for retirement or your child's college education. By categorizing your goals by time frame and risk tolerance, you can allocate your resources more effectively and ensure you're on track to meet your objectives. Your risk appetite, or how much risk you're willing to take on to achieve your goals, is a key factor in determining your investment strategy. Are you comfortable with the ups and downs of the stock market, or do you prefer the stability of bonds and cash? By aligning your investments with your risk appetite, you can sleep soundly at night, knowing your portfolio is well suited to your needs and preferences. Diversification, the golden rule of investing. By spreading your investments across a range of asset classes, sectors, and geographic regions, you can reduce the risk of your portfolio and increase its potential for long-term growth. Think of it like building a sturdy ship. If one part springs a leak, the rest of the vessel can stay afloat. By diversifying your investments, you can weather the inevitable storms of the market and stay on course toward your financial goals. Setting investment goals isn't a set-it-and-forget-it endeavor. It requires regular review and adjustment along the way. Just like you wouldn't sail across the ocean without checking your navigation charts, you shouldn't invest without regularly reviewing your portfolio and progress toward your goals. By monitoring your investments and making adjustments as needed, you can stay on track and navigate any unexpected twists and turns in the market. Sometimes even the most seasoned sailors need a navigator to help chart their course. If you're feeling overwhelmed or uncertain about your investment strategy, don't hesitate to seek professional advice. A qualified financial advisor can help you assess your goals, risk tolerance, and investment options, and develop a personalized plan to achieve your objectives. Remember, investing is a journey, and having the right guide can make all the difference. In the vast and varied landscape of investing, there's no one-size-fits-all approach. From passive index investing to active stock picking, there are countless strategies to choose from. In this section, we'll explore some of the most popular investment strategies and help you find the one that's right for you. The classic buy and hold strategy, the tortoise of the investment world. With this approach, you buy quality investments and hold onto them for the long haul, regardless of short-term market fluctuations. It's like planting a tree. You water it, nurture it, and watch it grow over time. While buy and hold investing requires patience and discipline, it can be a powerful way to build wealth steadily and reliably over the years. Dollar cost averaging is like the drip irrigation system of investing, a steady stream of investments trickling into your portfolio over time. Instead of trying to time the market, you invest a fixed amount of money at regular intervals, regardless of market conditions. This disciplined approach allows you to take advantage of market downturns by buying more shares when prices are low and fewer shares when prices are high. It's like getting more bang for your buck without the stress of trying to predict the market's every move. Value investing is like rummaging through the bargain bin at your favorite thrift store, hunting for hidden gems overlooked by the masses. With this strategy, you seek out undervalued stocks trading below their intrinsic value. and patiently wait for the market to recognize their true worth. It's not about chasing the latest hot stock or following the crowd, it's about doing your homework, crunching the numbers, and sticking to your guns. While value investing requires patience and a contrarian mindset, it can be a lucrative strategy for savvy investors willing to think outside the box. Growth investing is like betting on the next big thing scouring the market for companies with the potential to deliver rapid earnings growth and skyrocketing stock prices. With this strategy, you focus on companies with innovative products, strong leadership, and robust growth prospects, and ride the wave of their success to riches. It's not for the faint of heart. Growth stocks can be volatile and unpredictable, but for those with the stomach for risk, the rewards can be astronomical. Index investing is like taking the scenic route, a leisurely stroll through the market's vast landscape without breaking a sweat. Instead of trying to beat the market, you simply aim to match its performance by investing in low-cost index funds or exchange-traded funds ETFs that track major market indices like the S&P 500. It's a simple, straightforward approach that offers broad diversification, low fees, and steady, market-matching returns. While index investing may not make you a millionaire overnight, it's a reliable way to build wealth over the long term with minimal effort. Dividend investing is like collecting rent on your investments, a steady stream of income flowing into your pocket month after month, year after year. With this strategy, you focus on companies that pay regular dividends to their shareholders and reinvest those dividends to compound your returns over time. It's a tried and true approach favored by income-oriented investors looking for a reliable source of passive income. While dividend investing may not offer the same explosive growth as other strategies, it can provide stability and peace of mind in an uncertain world. Active trading is like playing the stock market on steroids, a fast-paced, adrenaline-fueled roller coaster ride of buying, selling, and chasing the next big opportunity. With this strategy, you aim to outsmart the market by timing your trades, exploiting short-term trends, and capitalizing on market inefficiencies. It's not for the faint of heart. Active traders must have nerves of steel, lightning-fast reflexes, and a stomach for risk. While active trading can be highly profitable in the right hands, it's also fraught with risk and uncertainty. Now that we've explored the various investment strategies available, it's time to roll up our sleeves and build your investment portfolio. In this section, we'll walk through the steps to creating a well-diversified portfolio that aligns with your goals, risk tolerance, and time horizon. Before you dive headfirst into the world of investing, it's essential to take stock of your risk tolerance. Are you comfortable with the ups and downs of the market, or do you prefer a smoother ride? By understanding your risk tolerance, you can tailor your investment strategy to match and avoid any sleepless nights worrying about market fluctuations. Next, it's time to clarify your investment goals. Are you saving for retirement, a down payment on a house, or your child's education? By defining your goals upfront, you can tailor your investment strategy to meet your specific needs and objectives. Asset allocation is like the blueprint for your investment portfolio. It dictates how you will divvy up your money among different asset classes like stocks, bonds, and cash. The key is finding the right balance between risk and return that aligns with your goals and risk tolerance. For example, if you have a long time horizon and high risk tolerance, you may opt for a more aggressive allocation with a higher percentage of stocks. On the other hand, if you're nearing retirement or have a low risk tolerance, you may lean toward a more conservative allocation with a higher percentage of bonds. With your asset allocation in place, it's time to choose specific investments to fill out your portfolio. Whether you opt for individual stocks, mutual funds, ETFs, or a combination of all three, Be sure to research each investment carefully and consider factors like historical performance, fees, and management quality. Remember, diversification is key. Spread your investments across different asset classes, sectors, and geographic regions to minimize risk and maximize returns. Once your portfolio is up and running, the work isn't over, it's just begun. Regularly monitor your investments to ensure they're performing as expected and rebalance your portfolio as needed to maintain your desired asset allocation. For example, if stocks have outperformed bonds and thrown your asset allocation out of whack, you may need to sell some stocks and buy more bonds to realign your portfolio with your target allocation. Finally, it's essential to stay the course and stick to your investment plan even when the market gets rocky. Remember, investing is a long-term endeavor, and short-term fluctuations are just noise in the grand scheme of things. Avoid the temptation to make impulsive decisions based on fear or greed and focus on your long-term goals and objectives. By staying disciplined and sticking to your plan, you can weather the inevitable ups and downs of the market and achieve your financial goals over time. Investing isn't just about making money, it's also about protecting what you've worked so hard to earn. In this section, we'll discuss the importance of risk management and strategies to safeguard your investments against potential threats. Diversification, the golden rule of risk management. By spreading your investments across different asset classes, sectors, and geographic regions, you can reduce the risk of your portfolio and increase its potential for long-term growth. Think of it like building a sturdy fortress for your investments. If one part crumbles, the rest of the structure can stay standing. Diversification won't eliminate risk entirely, but it can help mitigate the impact of any one investment going south. Asset allocation is like the rudder of your investment ship. It steers you in the right direction and keeps you on course. By balancing your portfolio across different asset classes like stocks, bonds, and cash, you can optimize your risk and return potential to match your financial goals and risk tolerance. For example, if you have a long time horizon and high risk tolerance, you may opt for a more aggressive allocation with a higher percentage of stocks. On the other hand, if you're nearing retirement or have a low risk tolerance, you may lean toward a more conservative allocation with a higher percentage of bonds. Before you make any investment, it's essential to assess the risks involved and determine whether they align with your risk tolerance and financial goals. Are you comfortable with the potential for market volatility, or do you prefer the stability of bonds and cash? By understanding the risks upfront, you can make informed decisions and avoid any unpleasant surprises down the road. Stop-loss orders are like the emergency brakes on your investment train. They kick in when things start to go off the rails. By setting a predetermined price at which to sell a security, you can limit your losses and protect your portfolio from catastrophic declines. It's like having a safety net in place to catch you if you fall, ensuring that your investments don't spiral out of control. An emergency fund is like a financial safety net, a stash of cash set aside for life's unexpected curveballs. Whether it's a job loss, medical emergency, or car repair, having an emergency fund can provide peace of mind and prevent you from having to liquidate investments at an inopportune time. Aim to keep 3 to 6 months' worth of living expenses in a high-yield savings account or money market fund, so you're prepared for whatever life throws your way. Insurance is like a suit of armor for your finances. It protects you from the unexpected and provides peace of mind knowing that you're covered in case of a disaster. Whether it's health insurance, life insurance, or homeowners insurance, having the right coverage in place can mitigate financial risk and prevent you from having to dip into your investment portfolio to cover unexpected expenses. Knowledge is power, especially when it comes to managing risk in your investment portfolio. Stay informed about economic trends, market developments, and geopolitical events that could impact your investments. Read financial news, follow market analysts, and stay abreast of changes in the regulatory environment. By staying informed and proactive, you can anticipate potential risks and take steps to mitigate them before they impact your portfolio. Investing isn't just about numbers and charts, it's also about human behavior and emotions. In this section, we'll delve into the fascinating world of behavioral finance and explore how psychology influences investment decisions. Emotions play a significant role in investment decisions, sometimes for better, often for worse. From fear and greed to overconfidence and regret, our emotions can cloud our judgment and lead us to make irrational decisions. Understanding how emotions influence our behavior can help us become more aware of our biases and make more rational investment choices. One of the most powerful forces in investing is loss aversion, the tendency to prefer avoiding losses over acquiring equivalent gains. In other words, we feel the pain of a loss much more acutely than the pleasure of a gain. This can lead investors to hold on to losing investments for too long, in the hopes of breaking even, rather than cutting their losses and moving on. By recognizing the influence of loss aversion, investors can learn to take a more disciplined and rational approach to managing their portfolios. Humans are social creatures by nature. We like to follow the crowd and do what everyone else is doing. This herd mentality can be especially pronounced in the world of investing, where investors often look to others for guidance and validation. However, blindly following the crowd can lead to herd behavior and create bubbles and crashes in the market. By being aware of the influence of herd mentality, investors can avoid getting swept up in the frenzy and make more independent and informed decisions. Confirmation bias is the tendency to seek out information that confirms our existing beliefs and ignore or discount information that contradicts them. In the world of investing, this can lead investors to cherry-pick data that supports their investment thesis and dismiss evidence to the contrary. By recognizing the influence of confirmation bias, investors can strive to seek out diverse perspectives and consider all available information before making investment decisions. Speaking of tax-advantaged accounts, they're like a secret weapon in the battle against taxes. From traditional IRAs and 401ks to Roth IRAs and SHAs, there are a variety of accounts available that offer tax benefits to investors. By contributing to these accounts and taking advantage of their tax-deferred or tax-free growth, you can shield your investments from taxes and supercharge your savings over time. Tax loss harvesting is like turning lemons into lemonade, making the best of a bad situation. It involves selling investments that have experienced losses to offset capital gains and reduce your tax liability. By strategically harvesting losses throughout the year and reinvesting the proceeds in similar but not identical securities, you can maintain your desired asset allocation while minimizing taxes. Asset allocation is like playing a game of chess, strategically positioning your investments to minimize taxes and maximize returns. By placing tax-efficient investments like stocks in taxable accounts and tax-inefficient investments like bonds in tax-advantaged accounts, you can optimize your after-tax returns and keep more money in your pocket. It's all about thinking several moves ahead and anticipating the tax consequences of your investment decisions. Taxes can be complicated, especially when it comes to investing. If you're unsure about the tax implications of your investment decisions or need help developing a tax-efficient investment strategy, don't hesitate to consult a qualified tax professional. They can help you navigate the complexities of the tax code, identify opportunities to minimize your tax liability, and ensure you're making the most of your investment dollars. Investing can be a rewarding journey, but it's not without its pitfalls. In this section, we'll shine a light on some of the most common investment mistakes and how to avoid them. Trying to time the market is like trying to catch a falling knife. It's a risky endeavor that often ends in pain. While it may be tempting to jump in and out of the market in an attempt to buy low and sell high, the reality is that timing the market consistently is nearly impossible. Instead of trying to predict short-term market movements, focus on your long-term investment goals and stick to a disciplined investment strategy. Overtrading is like playing a game of musical chairs. Sooner or later, you're bound to get caught without a seat. Constantly buying and selling investments in response to every market fluctuation can rack up transaction costs, trigger taxable events, and undermine your long-term investment performance. Instead of succumbing to the allure of frequent trading, take a long-term view of investing and resist the urge to tinker with your portfolio unnecessarily. Chasing performance is like chasing a mirage. It looks promising from afar but often leads to disappointment. It's easy to get swept up in the excitement of hot stocks or winning investment trends. But investing based on past performance alone is a recipe for disappointment. Instead of chasing the latest fad, focus on the fundamentals of investing: diversification, asset allocation, and long-term discipline. Ignoring fees is like leaving money on the table. It may not seem like much at first, but it adds up over time. Whether it's management fees, expense ratios, or trading commissions, fees can eat into your investment returns and erode your long-term wealth. Before investing in any fund or product, be sure to carefully review the fees involved and consider their impact on your overall returns. Putting all your eggs in one basket is like playing a high-stakes game of roulette. It's a gamble with your financial future. By failing to diversify your investments across different asset classes, sectors, and geographic regions, you expose yourself to unnecessary risk and limit your potential for long-term growth. Instead, spread your investments across a broad range of assets to minimize risk and maximize returns. Letting your emotions dictate your investment decisions is like letting a toddler drive a car. It's a recipe for disaster. Fear, greed, and panic can cloud your judgment and lead you to make impulsive decisions that undermine your long-term investment goals. Instead of letting emotions rule the roost, stick to a disciplined investment plan and tune out the noise of the market. Rome wasn't built in a day, and neither is a successful investment portfolio. Investing is a long-term endeavor that requires patience, discipline, and perseverance. Trying to get rich quick or expecting overnight success is a surefire way to set yourself up for disappointment. Instead, focus on the fundamentals of investing: saving regularly, diversifying your portfolio, and staying the course, and let time work its magic. While stocks and bonds may be the bread and butter of traditional investing, there's a whole world of alternative assets out there waiting to be explored. In this section, we'll take a look at some alternative investment opportunities and the potential benefits they offer. Real estate is like the Swiss Army knife of investing: versatile, reliable, and capable of serving multiple purposes. Whether it's residential properties, commercial buildings, or rental units, real estate can provide steady income, potential for appreciation, and diversification benefits to your investment portfolio. From fixer-uppers to turnkey rentals, there are countless ways to invest in real estate and build wealth over time. Commodities are like the lifeblood of the global economy, essential raw materials that power industries and drive economic growth. From gold and silver to oil and gas, commodities offer unique diversification benefits and serve as a hedge against inflation and geopolitical uncertainty. Whether you're bullish on precious metals or betting on the future of renewable energy, commodities can add an extra layer of diversification to your investment portfolio. Private equity is like the Wild West of investing, a high-risk, high-reward frontier where fortunes are made and lost. By investing in privately held companies or startups, investors can gain access to potentially lucrative opportunities that aren't available in the public markets. From venture capital to buyouts, private equity offers the chance to get in on the ground floor of tomorrow's success stories and participate in the growth of innovative companies. Hedge funds are like the rock stars of the investing world, exclusive, enigmatic, and often misunderstood. By pooling money from accredited investors, hedge funds can employ sophisticated investment strategies like long or short equity, global macro and event-driven trading to generate outsized returns and hedge against market downturns. While hedge funds come with higher fees and less transparency than traditional investments, they offer the potential for enhanced returns and risk management benefits for sophisticated investors. Cryptocurrencies are like the new kids on the block, disruptive, volatile, and full of potential. From Bitcoin and Ethereum to Dogecoin and beyond, cryptocurrencies have captured the imagination of investors worldwide. With their promise of decentralized finance and blockchain technology, while cryptocurrencies come with significant risks and uncertainties, they also offer the potential for astronomical returns for those willing to take the plunge into this brave new world of digital assets. Collectibles are like a treasure hunt. You never know what hidden gems you might find. From rare coins and stamps to vintage cars and artwork, collectibles offer the allure of nostalgia, passion, and potential profit. Whether you're a history buff, car enthusiast, or art aficionado, collectibles can add a touch of excitement and diversity to your investment portfolio while satisfying your passions and interests. Peer-to-peer lending is like cutting out the middleman, connecting borrowers directly with investors and offering the potential for higher returns than traditional fixed-income investments. By lending money to individuals or small businesses through online platforms, investors can earn attractive yields while diversifying their fixed-income holdings and supporting economic growth at the grassroots level. Environmental, social, and governance ESG investing is like the evolution of investing, a shift towards a more sustainable, responsible, and ethical approach to wealth creation. In this section, we'll explore the principles of ESG investing and the potential benefits it offers to both investors and society as a whole. Environmental factors are like the canaries in the coal mine, indicators of the health and sustainability of our planet. From climate change and pollution to deforestation and resource depletion, environmental issues pose significant risks to both the planet and the economy. ESG investors consider the environmental impact of their investments and seek out companies that are committed to reducing their carbon footprint, conserving natural resources, and promoting sustainability. Social factors are like the glue that holds society together, the fabric of human relationships, values, and communities. From labor practices and human rights to diversity and inclusion, social issues play a critical role in shaping corporate behavior and reputation. ESG investors consider the social impact of their investments and seek out companies that are committed to treating their employees, customers, and communities with fairness, respect, and dignity. Governance factors are like the guardrails of the investment world, the rules, policies, and practices that govern how companies are run and how decisions are made. From board diversity and executive compensation to shareholder rights and transparency, governance issues can have a significant impact on a company's long-term performance and stability. ESG investors consider the governance practices of companies and seek out those with strong leadership, ethical business practices, and effective oversight. Positive screening is like the search for hidden gems, identifying companies that are leaders in ESG performance and potential catalysts for positive change. By investing in companies with strong ESG credentials, investors can not only align their portfolios with their values but also support and reward companies that are making a positive impact on the world. Negative screening is like weeding out the bad apples, avoiding investments in companies that engage in activities or practices that are harmful to people, the planet, or society. from fossil fuels and tobacco to weapons and human rights violations. Negative screening allows investors to steer clear of companies with poor ESG records and minimize their exposure to ethical, reputational, and financial risks. Impact investing is like putting your money where your mouth is investing, with the intention of generating positive, measurable social or environmental impact alongside financial returns. Whether it's investing in clean energy projects, affordable housing initiatives, or sustainable agriculture practices, impact investors seek to create positive change while earning a profit. By harnessing the power of finance for good, impact investing offers a unique opportunity to address pressing social and environmental challenges and build a more sustainable and equitable future for all. ESG integration is like adding an extra layer of analysis to your investment process. Incorporating ESG factors into traditional financial analysis to gain a more holistic view of investment opportunities and risks. By considering both financial and non-financial factors in investment decision-making, ESG integration allows investors to identify opportunities, manage risks, and generate sustainable long-term returns. From identifying potential sources of alpha to managing downside risk, ESG integration offers benefits to investors, companies, and society as a whole. Robo-advisors are like the personal trainers of the investment world. They provide automated, algorithm-driven investment management services with minimal human intervention. In this section, we'll explore the rise of robo-advisors, how they work, and whether they might be right for you. Robo-advisors are like financial GPS systems. They provide personalized investment guidance and portfolio management based on your financial goals, risk tolerance, and time horizon. Using advanced algorithms and modern technology, robo-advisors analyze your financial situation and recommend a diversified portfolio of low-cost exchange-traded funds, ETFs, or mutual funds designed to help you achieve your investment objectives. Robo-advisors work like digital financial planners. They ask you a series of questions about your investment goals, risk tolerance, and time horizon, and then use that information to recommend a suitable investment strategy. Once you've chosen a strategy, the robo-advisor automatically builds and manages your portfolio, rebalancing it periodically to maintain your desired asset allocation and risk level. Robo-advisors offer several benefits over traditional human financial advisors, including lower fees, greater accessibility, and increased transparency. With robo-advisors, you can access professional investment management services at a fraction of the cost of traditional advisors, making investing more affordable and accessible to a wider range of investors. Additionally, robo-advisors provide transparent pricing and performance reporting, so you always know exactly what you're paying for and how your investments are performing. Despite their automated nature, robo-advisors offer a high degree of customization and personalization. Whether you're saving for retirement, buying a house, or planning for your child's education, robo-advisors can tailor your investment strategy to your specific financial goals, risk tolerance, and time horizon. From conservative to aggressive, robo-advisors offer a range of investment options to suit your needs and preferences. Robo-advisors are like the autopilot feature on a plane. They do the heavy lifting so you can sit back and enjoy the ride. With user-friendly interfaces and intuitive design, robo-advisors make investing simple and straightforward, even for beginners. Whether you're tech-savvy or technophobic, robo-advisors offer a hassle-free way to invest your money without the stress and complexity of traditional investing. While robo-advisors offer many benefits, they're not without their drawbacks. One potential downside is the lack of human interaction. If you prefer a more hands-on approach to investing or have complex financial needs, you may find robo-advisors too impersonal. Additionally, robo-advisors may not be able to provide the same level of personalized advice or tax planning services as traditional human advisors. So it's essential to weigh the pros and cons before making a decision. With so many robo-advisors on the market, choosing the right one can be overwhelming. When evaluating robo-advisors, consider factors like fees, investment options, customer service, and ease of use. Look for a robo-advisor that offers a diverse range of low-cost investment options, transparent pricing, and responsive customer support to ensure you get the most value for your money. Active and passive investing are like two sides of the same coin, each with its own philosophy, strategy, and proponents. In this section, we'll explore the differences between active and passive investing and help you decide which approach might be right for you. Active investing is like playing a fence in the investment game. It involves selecting individual securities or actively managed funds with the goal of outperforming the market. Active investors believe that by conducting thorough research, analyzing market trends, and making strategic investment decisions, they can generate higher returns than the broader market. While active investing offers the potential for alpha or above-market returns, it also comes with higher fees, increased risk, and the potential for underperformance. Passive investing is like playing defense in the investment game. It involves tracking a market index or investing in index funds or exchange-traded funds ETFs with the goal of matching the performance of the market. Passive investors believe that markets are generally efficient and that trying to beat the market through active management is a losing proposition over the long term. By minimizing costs, reducing turnover, and maintaining broad diversification, passive investors can capture the market's returns while avoiding the pitfalls of active management. The pros of active investing include the potential for outperformance, flexibility, and the ability to capitalize on market inefficiencies. However, active investing also comes with higher costs, increased taxes, and the risk of underperformance relative to the market. Additionally, research has shown that the vast majority of active managers fail to beat their benchmarks over the long term, making it challenging for investors to identify consistently skilled managers. The pros of passive investing include lower fees, greater tax efficiency, and the ability to capture market returns with minimal effort. By investing in low-cost index funds or ETFs, passive investors can build diversified portfolios that mirror the performance of the market at a fraction of the cost of active management. However, passive investing also means accepting market returns for better or for worse and missing out on the potential for alpha that active management offers. Some investors choose a hybrid approach that combines elements of both active and passive investing. For example, they may use passive index funds as the core of their portfolio and complement them with actively managed funds or individual securities in certain asset classes or market segments. By blending active and passive strategies, investors can potentially capture the benefits of both approaches while minimizing their drawbacks. Selecting the right broker plays a pivotal role in successful investing. A broker acts as an intermediary between investors and financial markets, providing access to trading and investment opportunities. In this section, we'll explore key criteria for choosing a broker and strategies to help you make the right decision. Key criteria for choosing a broker: reputation and reliability. When choosing a broker, pay attention to their reputation and reliability. Research the broker's history, licenses, ratings, and client reviews. Ensure that the broker has a solid reputation and adheres to high standards of security and reliability. Trading conditions. Evaluate the broker's trading conditions, including commissions, spreads, minimum deposits, and other fees. Choose a broker with competitive trading conditions that align with your needs and investment strategy. Available markets and assets. Check which markets and assets are available for trading through the broker. Ensure that the broker offers access to the markets and assets you intend to invest in, including stocks, bonds, funds, forex, and others. Technological platform. Assess the broker's technological platform used for trading and investing. Make sure the platform is user-friendly, reliable, offers a wide range of analysis tools and functions, and supports mobile trading. Customer service. It's important for the broker to provide high-quality customer service and prompt support. Investigate the quality and availability of the broker's customer support, their response to client inquiries and issues. Strategies for choosing a broker. Assessing needs. Analyze your investment needs and goals to determine the required features and services from a broker. Choose a broker that best suits your requirements and investment strategy. Comparing conditions. Compare trading conditions, commissions, available markets, and assets among different brokers. Research broker reviews and ratings to make an informed decision. Testing the platform. Before opening a real account, test the broker's trading platform using a demo account or paper trading. Evaluate its features, ease of use, reliability, and performance. By carefully considering these criteria and strategies, you can select a broker that meets your investment objectives and provides a reliable platform for your trading activities. Trading on the stock market can seem daunting at first, but understanding the basics can help demystify the process and set you on the path to becoming a successful investor. In this section, we'll explore the fundamental concepts of trading stocks and how to get started. Understanding stocks. Stocks, also known as shares or equities, represent ownership in a company. When you buy shares of a company's stock, you become a partial owner of that company and are entitled to a portion of its profits, known as dividends, and voting rights in certain corporate decisions. Key concepts in stock trading. Market orders vs. limit orders. Market orders are executed immediately at the current market price, while limit orders are executed at a specified price or better. Understanding the difference between these order types is essential for effective trading. Bid and ask prices. The bid price is the highest price a buyer is willing to pay for a stock, while the ask price is the lowest price a seller is willing to accept. The difference between these prices is known as the bid-ask spread. Volatility and risk. Stocks can be volatile, meaning their prices can fluctuate widely over short periods. Understanding and managing risk is crucial for successful trading. Technical and fundamental analysis. Traders use both technical analysis, which involves studying price charts and patterns, and fundamental analysis, which involves assessing a company's financial health and prospects to make informed trading decisions. Getting started with stock trading. Open a brokerage account to start trading stocks. You'll need to open a brokerage account with a reputable broker. Research different brokers and choose one that offers the features and services you need. Research and analysis. Before making any trades, conduct thorough research and analysis on the stocks you're interested in. Consider factors such as the company's financials, industry trends, and market conditions. Start small and diversify. When starting out, it's wise to begin with small investments and gradually increase your exposure as you gain experience. Diversifying your portfolio across different stocks and sectors can help reduce risk. Stay informed and adapt. Stay updated on market news and developments that may impact your investments. Be prepared to adapt your trading strategy as market conditions change. By understanding the basics of trading on the stock market and following these steps, you can embark on your journey as a confident and informed investor. Investment apps and platforms have revolutionized the way people invest, providing easy access to financial markets and investment opportunities. In this section, we'll explore the benefits of using investment apps and platforms, along with tips for choosing the right one for your needs. Benefits of investment apps and platforms. Accessibility. Investment apps and platforms offer convenience and accessibility, allowing investors to manage their portfolios anytime, anywhere, using their smartphones or computers. Cost effectiveness. Many investment apps and platforms have low fees and minimum account requirements, making them affordable options for both novice and experienced investors. Diverse investment options. These platforms provide access to a wide range of investment options, including stocks, bonds, mutual funds, ETFs, and more, allowing investors to diversify their portfolios easily. Research and analysis tools. Many investment apps and platforms offer robust research and analysis tools, including real-time market data, financial news, stock screeners, and analytical reports, helping investors make informed decisions. Automated investing. Some platforms offer automated investing services, such as robo-advisors, which use algorithms to build and manage portfolios based on investors' goals and risk tolerance. Tips for choosing an investment app or platform. Security and regulation. Ensure that the app or platform is regulated by a reputable financial authority and employs robust security measures to protect investors' assets and personal information. User-friendly interface. Look for an app or platform with an intuitive and user-friendly interface that makes it easy to navigate. Research investments, place trades, and monitor portfolio performance. Cost and fees. Consider the fees and commissions charged by the app or platform, including account maintenance fees, trading fees, and any other charges. Choose a platform with transparent and competitive pricing. Customer support. Evaluate the quality and responsiveness of the app or platform's customer support services. Look for platforms that offer prompt assistance and reliable customer support channels. Integration and compatibility. If you use other financial tools or services, ensure that the investment app or platform is compatible and integrates seamlessly with them for a smooth user experience. By leveraging investment apps and platforms effectively and choosing the right one for your needs, you can streamline your investing process and make informed decisions to achieve your financial goals. Technical analysis is a method used by traders and investors to evaluate securities and forecast future price movements based on historical market data. In this section, we'll explore the fundamental tools and methods of technical analysis that can help inform investment decisions. Key tools of technical analysis. Price charts are graphical representations of historical price movements of a security over time. Common types of charts include line charts, bar charts, and candlestick charts, each providing different levels of detail. Moving averages smooth out price data to identify trends and support and resistance levels. Common types of moving averages include simple moving averages SMA and exponential moving averages EMA. Support levels are price levels where a security tends to find buying interest and bounce higher, while resistance levels are price levels where selling interest tends to emerge and push the price lower. Identifying these levels can help traders anticipate potential price movements. Technical indicators are mathematical calculations based on historical price and volume data. Examples include Relative Strength Index RSI, Moving Average Convergence Divergence MACD, and Bollinger Bands, which help traders gauge momentum, trend strength, and overbought or oversold conditions. Volume is a measure of the number of shares or contracts traded in a security during a given period. Analyzing volume patterns alongside price movements can provide insights into the strength or weakness of a trend. Methods of technical analysis. Trend analysis involves identifying the direction of the primary trend in a security, whether it's up, down, or sideways. Traders often use trend lines or moving averages to identify and confirm trends. Chart patterns are formations that appear on price charts and can signal potential trend reversals or continuations. Common chart patterns include head and shoulders, triangles, and flags, which traders use to make trading decisions. Technical indicators generate buy or sell signals based on their calculations. Traders interpret these signals in conjunction with other technical analysis tools to make informed trading decisions. Risk management is a crucial aspect of technical analysis, as it helps traders determine appropriate entry and exit points, position sizes, and stop-loss levels to minimize losses and protect capital. By mastering the key tools and methods of technical analysis, investors can gain valuable insights into market trends and price movements, enabling them to make more informed investment decisions. Fundamental analysis is a cornerstone of investment research, focusing on evaluating the intrinsic value of a security by examining various qualitative and quantitative factors related to the underlying asset, such as its financial performance, industry position, and economic outlook. In this section, we'll explore the principles and approaches of fundamental analysis, and how investors can use them to make informed investment decisions. Key principles of fundamental analysis: understanding the business. Fundamental analysis begins with understanding the underlying business or asset being analyzed. Investors examine the company's products or services, its industry, competitive advantages, and management team to assess its long-term growth prospects. Evaluating financial statements. Fundamental analysts scrutinize a company's financial statements, including its income statement, balance sheet, and cash flow statement, to assess its financial health and performance. Key metrics such as revenue growth, profit margins, debt levels, and cash flow are analyzed to gauge the company's profitability, liquidity, and solvency. Assessing economic and industry trends. Fundamental analysts consider broader economic and industry trends that may impact the company's operations and future prospects. Factors such as GDP growth, interest rates, inflation, regulatory changes, and technological advancements can influence industry dynamics and company performance. Valuation analysis. Fundamental analysts use various valuation models and techniques to determine the intrinsic value of a security. Common valuation methods include discounted cash flow (DCF) analysis, price to earnings (PE) ratio, price to book (PB) ratio, and dividend discount models (DDM). By comparing the calculated intrinsic value to the current market price, investors can identify potential investment opportunities. Approaches to fundamental analysis. Top-down approach. This approach involves analyzing macroeconomic factors, industry trends, and market dynamics to identify promising sectors and industries before selecting individual stocks within those sectors. Bottom-up approach. In contrast, the bottom-up approach focuses on analyzing individual companies in depth, regardless of industry or sector trends. Investors look for companies with strong fundamentals, competitive advantages, and growth potential. Qualitative analysis. Qualitative factors such as management quality, brand reputation, competitive positioning, and corporate governance practices are also considered in fundamental analysis. These qualitative insights provide valuable context and complement quantitative analysis. By mastering the principles and approaches of fundamental analysis, investors can gain valuable insights into the underlying value of securities and make well-informed investment decisions aligned with their financial goals and risk tolerance. Portfolio management is the art and science of creating and managing an investment portfolio to achieve specific financial objectives while minimizing risk. In this section, we'll explore various portfolio management strategies and tactics. that investors can employ to optimize their investment portfolios. Portfolio management strategies. Diversification. Diversification is a fundamental strategy that involves spreading investments across different asset classes, sectors, industries, and geographic regions to reduce the overall risk of the portfolio. By diversifying, investors can mitigate the impact of individual asset volatility on the overall portfolio performance. Asset allocation. Asset allocation is the process of determining the optimal mix of asset classes, such as stocks, bonds, cash, and alternative investments based on an investor's financial goals, time horizon, and risk tolerance. Asset allocation strategies include strategic asset allocation, tactical asset allocation, and dynamic asset allocation. Risk management. Effective risk management is crucial in portfolio management to protect against potential losses. Strategies such as setting stop-loss orders, implementing hedging techniques, and using position sizing techniques can help manage risk and preserve capital during volatile market conditions. Rebalancing. Regular portfolio rebalancing involves periodically adjusting the portfolio's asset allocation back to its target weights to maintain the desired risk-return profile. Rebalancing ensures that the portfolio remains aligned with the investor's goals and risk tolerance over time. Portfolio management tactics. Long-term investing. Adopting a long-term investment horizon allows investors to take advantage of the power of compounding and ride out short-term market fluctuations. Long-term investors focus on fundamental analysis, buy and hold strategies, and patience to achieve their investment objectives. Investors can choose between active portfolio management, where portfolio managers actively buy and sell securities to outperform the market, and passive management, where portfolios are designed to replicate the performance of a specific market index through index funds or ETFs. Tax-efficient portfolio management aims to minimize the tax impact of investment decisions by utilizing tax-deferred accounts, tax loss harvesting strategies, and strategic asset location to optimize after-tax returns. Monitoring and review. Continuous monitoring and periodic review of the investment portfolio are essential to ensure it remains aligned with changing market conditions, economic trends, and personal financial goals. Investors should regularly assess portfolio performance, risk exposure, and market outlook to make informed adjustments as needed. By implementing effective portfolio management strategies and tactics, investors can build well-diversified portfolios that align with their financial objectives, risk tolerance, and investment preferences. Trading strategies encompass a wide range of approaches used by investors to buy and sell securities with the aim of generating profits. In this section, we'll explore two primary trading strategies: long-term investing and short-term trading, along with their characteristics, advantages, and considerations. Long-term investing. Long-term investing involves buying and holding assets for an extended period, typically several years or more, with the expectation of capital appreciation and wealth accumulation over time. Key features of long-term investing include focus on fundamentals. Long-term investors prioritize fundamental analysis, assessing a company's financial health, growth prospects, competitive advantages, and management quality to identify high-quality investments with long-term potential. Patience and discipline. Long-term investing requires patience and discipline to weather short-term market volatility and fluctuations. Investors remain focused on their investment thesis and resist the temptation to make impulsive decisions based on short-term market movements. Compounding returns. Long-term investors benefit from the power of compounding, where reinvested dividends and capital gains generate additional returns over time. Compounding allows investors to accelerate wealth accumulation and achieve their financial goals. Short-term trading. Short-term trading, also known as active trading or day trading, involves buying and selling securities within a short time frame, typically hours, days, or weeks, to capitalize on short-term price movements. Key features of short-term trading include technical analysis. Short-term traders rely heavily on technical analysis, using charts, patterns, indicators, and trading signals to identify short-term trading opportunities based on price trends, momentum, and market sentiment. Quick profits. Short-term traders aim to profit from small price movements in the market, executing frequent trades to generate short-term gains. They often employ leverage and margin trading to amplify potential profits, but this also increases the risk of losses. Active monitoring. Short-term trading requires active monitoring of the market throughout the trading day, as traders seek to capitalize on intraday price fluctuations and emerging trading opportunities. Quick decision-making and agility are essential in executing trades effectively. While long-term investing offers stability, growth potential, and reduced transaction costs, short-term trading provides opportunities for quick profits but requires active management, discipline, and risk management. Investors should carefully evaluate their investment goals, risk tolerance, and time horizon when choosing between long-term investing and short-term trading strategies. Market efficiency is a fundamental concept in finance that refers to the degree to which asset prices reflect all available information. In this section, we'll explore the concept of market efficiency and its significance for investors in making informed investment decisions. Understanding market efficiency. Efficient market hypothesis M. The efficient market hypothesis proposes that financial markets are efficient and incorporate all available information into asset prices. According to M, it is impossible to consistently outperform the market because prices already reflect all relevant information. Types of market efficiency. Weak form efficiency. Prices reflect all past trading information, such as historical prices and trading volume. Semi-strong form efficiency. Prices reflect all publicly available information, including past trading information and publicly available news and announcements. Strong form efficiency. Prices reflect all information, including both public and private information, making it impossible for any investor to gain an edge over the market. Importance of market efficiency for investors. Implications for active management. The concept of market efficiency has significant implications for active portfolio management. If markets are highly efficient, it becomes challenging for investors to consistently outperform the market through stock picking or market timing strategies. Focus on passive investing. Given the challenges of beating the market, many investors opt for passive investing strategies, such as index funds and exchange-traded funds ETFs, which aim to replicate the performance of a market index rather than actively trying to beat the market. Emphasis on fundamental analysis. While market efficiency suggests that it's difficult to gain an edge through stock selection, fundamental analysis remains crucial for investors. Even in efficient markets, undervalued or overvalued opportunities may arise due to misinterpretation of information or behavioral biases. Long-term perspective. Market efficiency reinforces the importance of adopting a long-term investment horizon and focusing on factors within an investor's control, such as asset allocation, diversification, and cost minimization, rather than attempting to time the market or chase short-term trends. Understanding market efficiency allows investors to set realistic expectations, adopt appropriate investment strategies, and focus on factors that can enhance long-term portfolio performance.